everything together. And yes, 100%, this will be recorded. So if you have to walk away or can't make the entire thing, don't worry at all. This will be recorded and archived for you to watch as many times as you want on the website.
All right, thanks, Richard. Appreciate the intro. Let's just hop right into it. So, as Richard said, today is going to be, about stop losses, position management, and selling. This is, in my opinion, the most difficult part of trading because oftentimes when you're selling, you're kind of fading your own emotion. You're letting go of a good position that's done well for you, or you're cutting a losing position, which people hate to lose money, right? But it is also likely the most important part of trading. Um, so I'm just going to start off by kind of explaining what I think the three different types of stop losses are. But then the key is here at the top is to highlight that stop losses allow you to control the risk reward equation. So, there's a lot of people who are buy and hold, who, trust me, I get the messages all the time, like don't use stops, all that stuff. And that's fine, but it's just not my strategy. So my strategy is, I'm a trader, and my goal is to control that risk reward relationship. And it's what I mean by that is really the only thing you can control in trading is literally how much you're risking. You don't have control over anything else. So if you can control that and then try to put yourself in positions where there's a potential reward that's a multiple of your risk, and you can work that over and over and over again through time, hopefully you can kind of make yourself the house, like the casino. um, so the three different types of stop losses for me are the initial stop loss. It literally allows you to understand how much principal risk you're going to be taking. It allows you to determine the position size that you're going to be taking on a specific position. And then when you know the risk on that position and your position size, it allows you to also manage your portfolio in the sense that you can look at the risk you have on multiple positions and understand your overall portfolio risk. Secondly, is the rising stop loss. So this is the stop loss that allows you to protect your open profits. It also allows you to understand, how much potential pressure your portfolio could be taking if all your positions were to stop out. So via your initial stop loss and your rising stop loss, you should be able to calculate literally how much could I lose if all my positions stop out. Then lastly is your final stop loss. And this allows you to exit positions that may have run their course. The reason this is important is because by going to cash when those positions have made their move, we're able to reallocate that capital to new opportunities. So the types of stop losses for me are your initial stop loss, your rising, call it, your position management stop loss, if you will, and then your exit stop loss. And really, they all help to either protect your principal. They really all help to protect your principal at all times, because once a position's moved, your principal is increasing, and you want to protect those gains. So next would just be to highlight that stop losses move up but never down. So I think one of the mistakes that beginners and even more advanced people, anybody, can make is you've got a stop loss in there, and then the stock approaches it, and I really like this stock. I'm gonna give it a little more room, and that's a mistake. If you've analyzed your charts and your positions, and you've determined, hey, this is where my stop should be, it should only move up. It should never move down. So those are the most important things I want you to take away from this slide. And then just next, some you know things that I try to do is, it is generally best, if possible, to try to wait for the end of the day or week, um, to trigger your stop losses. But that is with the caveat that, if your stop does hit, you got to execute. So I know a lot of people, if they think their stop's going to hit, myself included, you may try to exit the position early. Um, and, just generally, the goal would still be to try to wait for the end of the day or week if possible, rather than exit early. Now there's certainly cases where you just want to get out, because you feel your stop's going to be hit, and that's fine. But I urge you to try to wait for the end of the day or the week. Um, and then lastly, I'm going to go over a couple different strategies into how to manage positions and put your stops on your positions. And it's important to highlight that different strategies work better in different types of markets. So in a trending market versus a non-trending market, using different approaches to managing your positions are going to work differently. And that is kind of the art of stop loss placement. So I'm going to run through that, but just kind of understand that. Okay, so to start off, let's just start at the beginning. I think most of you people who've been through the course so far understand that I'm mostly playing breakouts, or pullback buys. But basically, where do we put that initial stop? So for me, if you buy a breakout, the fact that that stock is breaking out is literally the reason you're buying the stock. So if the breakout fails, the reason for buying the position in the first place is no longer present. And kind of one of my key caveats is, if your reason for buying is no longer there, then you shouldn't be in the position anymore. So if you buy a breakout, the breakout shouldn't fail. And that's the key thing there. So for me, the initial stop, when you're calculating kind of your max pain or your position size, generally when you're buying a position, there's some sort of shelf or mini consolidation, and you want to use that as your kind of initial max pain stop. Then from there, once the breakout gets moving, and you feel like, hey, this is sound, we've moved through the pivot, the stop for me should be moved to the breakout day low. And then from there, we want to try to get our stop to break even as quickly as we can without also choking that position off. I mean, the goal is to make money, so you do need to give your stock some wiggle room, and you don't want to move your position or your stop loss to break even too quickly, where you might lose your position. Then I think as you get a little bit more advanced and have more conviction in your trading, I use something that I call pivot manipulation. I actually came up with this name from a guy who I'm kind of helping learn trade. He named this, but it's managing your stop around the actual pivot point you create for yourself, which kind of comes back to a breakout working or failing. Basically, you want to manage it around that actual pivot, and if it comes back down through the pivot, sometimes it's best to exit the stock. Now, if you get in situations where a stock squats and then it goes a day or two later, my approach of kind of keeping slightly tighter stops, I would say, it can cause you to sometimes miss out on those opportunities, or maybe you have to buy it back. But in situations where that breakout flat out fails, you're going to be out of the way with kind of how I manage stops. So like anything else, there's always trade offs, but I'm just more comfortable using tighter stops.
And just because I'm sure people are wondering, what in general is kind of that? What does a tight stop mean for you in terms of percent? Let's say.
Sure. So I would say my stops are generally between 1% and 3%, depending on my position size. So, I'm a momentum trader for sure. And oftentimes when I'm buying a stock, I'm buying it because I expect it to work. And
Right.
I think most veteran traders, guys I've learned from, one of the things they always, kind of drill down is most of my winners work right from the start. If you're buying at a good spot and if you've analyzed the stock correctly, it's very common on a winning position that you'll never be in the red. So, for me, it's about 1% a lot of the time, but there's certainly more volatile stocks where that is like, that might even be like the spread on a stock. So it's unrealistic to have 1% stop on all positions for sure. I would say, let's say I have very very high conviction on something, um, and I just want to make sure that I get it. There are situations where I may use like a 5% stop, but I'm likely taking a smaller position and then trying to pyramid, um,
Right.
just to make sure I get it. So every situation is a little unique, but I would say that 1% to 3% range is probably fairly accurate for about 90% of my trades.
And like you said, this can lead you getting stopped out a few times eventually before a stock actually starts working for you. But you're willing to let that happen, and you're always willing to re-enter stock if it sets back up again.
Yeah, absolutely. I mean, it's not uncommon for me to take a couple paper cuts and then get it right.
Right.
And I'm comfortable with that. I'm not the type of person who does well when I'm in the red. Um, so I'd rather just get stopped out and buy it back.
Gotcha. Perfect.
Yeah. So a couple of visuals on this. So there's something that I call my max pain stop loss. This is really a stop that I'm hopefully not planning on executing on, but I feel like you literally, no matter what, like have to know where you're absolute out of this. No questions asked. Like no waiting for the end of the day. Whatever. Like it hits this level, I'm gone for sure because the stock is just flat out broken. And for me, let's say I'm buying a breakout out of a consolidation. My max pain is below that consolidation. Whether it's like the day before the breakout day's low, it's somewhere within that range. And that's an area you can use to one, you kind of take your conviction in the position and then you measure, the percent to your stop loss, and then you can work to calculate your position size based on how much risk you want to take per position. So that's kind of what I call the max pain stop. If this thing just totally stinks and doesn't work, I'm going to stop out there. But really, once a breakout starts to work for me, and we push through the pivot, and I feel like, hey, this breakout has happened. I want to get my stop to the low of the day, and sometimes that can work or can occur like literally very quickly. I can tell you within the last 6 months or so, there's been many times where I've gotten long a stock and it's ripped. I've been like 3% in the money, and then it's reversed and stopped out, and it's happened all within the first the first 10 minutes of the day. And in those situations, my stop is already to the low of the day because the stock has pushed through the pivot very definitively, um, and then it does happen to reverse and you get stopped out. So max pain stop is kind of A for me, but then two, and hopefully as soon as possible, once that stock gets moving out of the breakout definitively, I want to get my stop to the low of the breakout day. And then from there, my goal is to try to get my stop to around break even. So unfortunately, we don't always all execute, right at the pivot. Sometimes there's a little bit of slippage and things like that. So, there's, potential our price to be a little bit past the breakout. Um, so step three for me is I want to try to get my stop to around break even, but you don't want to move your stop to break even so quickly that you risk losing a good position. So, kind of how I think about it is okay, we had our breakout and our stop is at the day's low now. Now we get follow through, and that may be the next day, it may be the day after. So, it may be, a couple days later. But once you get that follow through where you feel like, hey, this thing's going to work, you want to move your stop to break even. And I don't mean literally look at your price and like put it next to your price. I mean like that rough general area up in here. So let's say it goes up and it pulls back a day. Maybe your price was up here a little and you're in the red a little bit. I'm more, you'd probably still be in it, but let's say that it follows through down through this day's low now. Now you want to exit the position to me. And that may just be a little bit above the breakout day low, but it's more an area. So we break out, we get our stop to the day's low, and then we want to use our discretion to get it to around break even to try to protect our principal. As soon as we can within reason, and that we don't want to choke a position off for no reason. So those are kind of the three steps in my initial stop loss. So your max pain level, the breakout day low, and then around break even when you start to get follow through in the position.
A few questions, Oliver. First, would you mind turning on the laser pointer so people can see your pointer?
Sorry.
Yeah, no problem. And there was a really good question. I think, do you implement anything like a time stop where we have a breakout, then it just goes sideways and nowhere? Would that cause you to exit the position, or how do you handle that situation?
Yeah, I think that's a phenomenal question. I do use time stops in this. I don't have any, defined rules around a time stop, but let's say a stock breaks out and then it just goes nowhere for like a week or two, and I just sort of feel like I don't have my money in a top piece of merchandise. I may just exit that position, and I'm going to show you an example of that in this session on a stock that ended up actually working really well, and I bought back a little bit higher. um, but yeah, I think if you are in a position and you kind of expect it to run and it's just not moving, and maybe other opportunities are, and you decide, hey, I think my capital is better at work somewhere else, and then I think it makes sense to exit that position. But you're doing it because you think there's something else out there. I would say a time stop should it shouldn't be like 2 or 3 days. Maybe it's a week or two. Because again, a stock can go and then maybe it pulls back for 3 days, and there's not necessarily anything wrong with that. So I don't have any defined rules around time stops, but I think it's more taking into account what other opportunities are there that I might be missing, um, and yeah.
And there's also a question that I think a lot of people have on their minds. Do you use market orders, stop loss orders, or are you more setting alerts and you've got a mental stop or stop written down on paper? That's kind of your stop loss level.
Yeah, so I execute all my stops. I don't use hard stops. I mean, I may put a hard stop in on something, here and there, but generally speaking, I am executing my stops, and I always use market orders. I would say for 99.9% of my trades, I'm using a market order.
Perfect. I think that's most of the questions that people have asked to this point, so I think we can move on.
Okay. So kind of after your initial stop loss, something that I use is price strength confirmation, or I call it, reconfirming price strength confirmation. And then next would be something that I call ignite bars. Price strength confirmation is just the idea that, price moves up, it pulls back, or it does what I call it rests, and then it reconfirms. It moves back higher, and makes a new price high. And when that happens, you have a small consolidation that's been created via that resting action. And the goal is, once you get that reconfirmation, to raise your stops to below that new consolidation, so that your stops are being raised as price advances. And this is, to me, just a total play on Darvis. I think Darvis's, boxes were probably much bigger than mine, in that he was likely trading more off weekly charts, but it's the same concept. Price moves up, it rests, it consolidates, and then it moves back higher, and then it will rest again at some point, consolidate, and then it'll reconfirm, move back higher again. And you want to be trailing your stop below those resting periods, those consolidations, so that you can be protecting your open gains, but then also allowing the position to work. So if you just kind of think about the psychology behind that, let's say we get a breakout. Or here, let's use this example here on Tesla. So we get a breakout, right? It moves up, 2 or 3 days. Buyers are control. They're pushing prices higher as they step in and pay the offer, if you will, more aggressively. And sellers are hitting the bid. And then what happens? They say, "Oh man, we've moved 3 days. Let's take a break. Let's take a break." Maybe you have your really short term kind of 3-day type swing traders who take some profits here into this gap up, and then you pull back another day. In this specific instance, Tesla also had earnings, so maybe you had people here who took some gains before earnings. But then what happens? We reconfirm and we take out this high. So we move up, we pull back, we reconfirm higher, then we continue higher, and then what happens again? Your 3-day, 4-day type traders, they probably took some profits here, because that's their strategy. And maybe the guys who were buying in here, they just say, "Oh man, we've moved so far for 3 days. Let's take a break." And what happens? You get a couple days of consolidation, and then they say, "Oh man, it's not going to come back down for us to buy more shares. Well, I guess let's come back in and start buying again." And we reconfirm. So what you want to be doing there is, you move up, you base and reconfirm. Okay, let's move our stop up to below this little mini consolidation. We move up, we base, we reconfirm higher. Okay, let's move our stop up to below this little mini consolidation. And that's really what you're doing, is you're letting the stock consolidate, and then when buyers start to take control again, you want to move your stock to below that little consolidation, to protect your gains. And it's really that simple. So the second step to this is a concept that I call ignite bars. So ignite bars, to me, are wide range bars that hold significance due to their positive price action. So this isn't just any old, bar on the chart. It's a noticeable bar of wide range, especially if there's volume. So, for example, on this bar right here, which is an Ignite bar, look at the volume. Um, this is buying power, right? Like, there's a reason this stock moved because there were a lot of people buying the stock. So, if we were to lose the low of this day, guess who would be underwater on their position? All the people who created this volume. So the lows of these bars should not be lost, and I say they hold more weight if they occur on volume. So basically, if you're managing a position and you're raising your stops based on reconfirmation, and then you get a big bar like this with volume, I also want to be raising my stops to below the Ignite bar day low. Strictly for that reason that there's a reason that bar happened. Like people pushed it higher. So we shouldn't lose that day's low because then all the people that created that up bar are underwater, which has the potential to create sell pressure. So two things to take away from this slide. Price strength confirmation, the idea that stocks move up, they base, move higher, and then Ignite bars, the idea that when we have a major bar of significance, especially if it's on volume, it's a sign that buyers were aggressive in pushing the stock higher, and so those points on the chart should hold if the stock is healthy, because if they break, there's a larger force who likely sold into that advance. And then one thing that I would say here as well is when you get a significant up bar that's on extremely light volume. So let's just imagine, this bar had, 1/4 of the volume. It's not to say that that's going to roll over right away, but you want to be thinking, who was actually pushing this stock higher here? Likely retail investors, because there's no volume. So that is why volume is important to take note of on these Ignite bars. But Richard, any questions on this slide?
I'm not. Let me check on this slide right here. Um, is there a minimum percentage move to define an Ignite bar? And yeah, how do you determine whether something is an Ignite bar?
So there's no. I look at it just to be totally honest. Um, Different stocks are going to have different percentages, right? If we're trading a low float small cap stock, an Ignite bar might be 12 to 15%. Like the thing may really, really move around. Whereas if we're trading a, larger cap liquid name, maybe like a Microsoft or an Apple, an Ignite bar might be 4 or 5%, because it takes more dollars to move that stock. Um, so it is dependent on the volatility of a stock. I don't personally use things like ATR, but I'm sure somebody could run some sort of test and say like an Ignite bar is 3 times the ATR or something
Right.
like that. For me though, like if we just look at this stock, like forget it's Tesla, just like look at the price bars. We have very tight price bars all through here. We see, in advance. Really, this is like the biggest price bar here. It's the breakout bar. You would kind of expect that. Um, but then this is an outlier for sure. Like,
Mm-hmm.
I don't even need to know what the percent move is. I just kind of look at it. I mean, this is a bar of significance. This right here to me is a bar of significance, in the sense that by eyeballing it, it's a outlier as far as character of the stock and how it moves day in and day out. So that's how I look at Ignite bars. Um, no, you know, percent or anything like that because each stock is different. Weigh it versus the other price action of the daily bars from the stock.
Gotcha. And here's a good question from Tanya. Would you move this stop if the Ignite bar was retail, meaning it was on pretty low volume?
Yeah, so I would move the bar, um, and I would actually just be aware, like, hey, is this Ignite bar likely to fail?
Right.
Like I can think of, and I really added this specifically last year. I was trading Roku, and Roku had a huge up bar, and I was pretty fired up, right? And I was like, oh man, the volume on this is just like so light though. It's so weird that it moved this much on my volume. And sure enough, it sort of chopped around for a few days, and there was no follow through, and it came down and failed. And it really surprised me because I'd always felt like Ignite bars, move higher. But then it's like, well, like it was a bar created without much buying power. So I would just be more suspicious of low volume Ignite bars. I also think if you start to get really, really, really extended, especially from the 10-week and the 10-day, I think you'll notice if you study enough charts, and this certainly doesn't always hold true, but near the end of moves, you might get like three Ignite bars in a row. And if you see them, start to occur, I mean, they can also be on heavy volume. So at the end of a run, but sometimes they'll just be kind of floating on air. And those can be opportunities actually in those instances to take your position off. Um, so just be more suspicious of low volume Ignite bars.
Perfect. And there's a question specifically about the Tesla chart here. The bar after that huge Ignite bar has a pretty poor close, and it's also on high volume. Um, would that type of bar cause you to tighten up your stop? It's the one right. No, right here, right here. Can you see that?
This one? Yeah.
Yeah.
Um, so this is something that I would say is you want to take it in context, right? So
Right.
this is day 4 post breakout. In
Right.
reality, we had earnings here, and this is day 4. So to me, this is profit taking for people who, generally you'll see a lot that after a breakout you'll get some profit taking on like day 3. I think there's a lot of swing traders who they sell into that third day.
Right.
And one of the mistakes that I would make a lot, a couple of years ago, is I would see a shooting star like this near the beginning of a move, and I would sell on this day, and I'd say, "Oh man, like this thing's gonna tank or whatever." But a lot of the times, these shooting stars like this, like people forget that a shooting star needs confirmation, so it needs to take out this day's low for this chart or this candle to actually confirm. Um, and a lot of the times you'll see, because it's day 3 or day 4, this is really just a resting bar. One of the things that I really learned from Trader Florida is I'll see bars like this a lot where maybe it finishes up like 1%, but maybe it was up like 5% at one point. And it's like, oh, actually, the stock advanced today. And then the next day it does something like this, it consolidates. And in reality, this is just a consolidation bar. You had your late buyers that maybe got shaken out. You had your people who bought here who took some profits. But the bigger institutional type players, they were likely just holding off on continuing to buy their position, and sure enough, they step in, support the stock, and it continues higher. So I would say take it in context as to where the stock is. If this candle occurred, up here, I would say, oh yeah, you want to be concerned about that candle because we've moved, 50%, and now we're multiple weeks post breakout, we want to keep an eye on this thing. But because of where it occurs, I would be less concerned with it.
Absolutely. Context is so important.
Yeah.
Absolutely. And there's a good question here from Jay. And we covered this a little bit last seminar when we talked about building into positions. But if you, for instance, buy on the breakout, buy on the first wedge pop, and then add as it reconfirms on an EMA crossback, like basically the first two entry points here, are your stop losses? Do you treat your stop losses individually, or do you treat that entire thing as one position?
Sure, that's a really, really good question. Thanks. So let's say you bought down here. You want to manage the stop loss in this position here. And for, we'll call it position A. As you move up and then reconfirm, maybe on position A, you're keeping your stop, down here a little. But let's say you start a second position here, your stop is the day's low. And then as it gets moving, you want to move it, kind of up to here because you want to manage your principal risk on position B. But position A, you may still keep it down here, right? But then kind of as it gets moving and it follows through, and maybe you move your stop up to this area, I would start to manage position A and B together at this point. And then as you get the ignite bar, I'd be adjusting my stop for position A and B together. But then let's say we get here and we have a wick play, right? And you decide to start a third position, we'll call it position C. So position C, let's say we bought here, I would have my stop on position C here, whereas on A and B, it might still be down here, right? Because, your cost is different. And then as it, follows through, for me, position A and B, I'd probably move up to like right here, whereas position C, I'd probably have here. And then as it follows through again, and I get this ignite bar, now I'm trading A, B, and C together. That's kind of how I treat it. Every new position I take, I'm managing the risk uniquely on that entry. So the answer is you're treating them differently, but as the stock starts to move, you can start managing those entries together. I will say like a later buy area, maybe you're treating an entry here more as like a swing, right? Like a 2 to 3 day swing. So maybe on position C, because you bought it later, you're taking it off more quickly. And it's more like cash flow for you because you're cognizant of the fact you bought it later. And maybe that allows you to give position A and B, a little bit more room too. So to answer that question, you treat each buyer uniquely because you have a unique principal risk on each entry. But as the stock starts to move and just managing the stock correctly, it may bring the stop for all three positions into alignment.
That's perfect. And there's also a question here from Scott that I thought was really good. If basically, would you consider buying twice on the same day on the breakout if you moved your stop to low of the day and got stopped out, but then the reversal looks promising and moves back through that original pivot?
Sure. Yeah. I mean, that's just part of the game. Sometimes you get shaken out and you're wrong and you buy it back. I hate when that happens, but
Yeah,
but it happens.
it's part of the game. Yeah.
Yeah.
Okay. And then people are asking basically when you do decide to sell, what shares are you selling of that total position? Say you bought 3 times, are you selling the last batch first or the first batch first? Last in, first out versus first in, first out.
Yeah, so it's what I do is I have my trading software set to last in, first out, and for me it really doesn't matter because most of my gains are short term.
Yeah.
But I do have, the idea in the back of my head that just maybe eventually I'll have a long term gain It hasn't really happened yet, but I do last in first out, just in case maybe a stock runs up the moving averages for like 12 months.
Right.
I want to get long-term gains on my initial shares,
Perfect.
which rarely never happens, but maybe eventually.
There you go. Perfect. I think we can move on to the next slide.
Okay, so the 10 and 20 period moving average. As you guys know, having gone through the cycle, these moving averages and the price movements of the stock around these averages is really kind of the key to my whole strategy. So often, price strength confirmation and things like that works like literally in alignment with the moving averages. Price will move up and it'll rest, and oftentimes it'll rest right into the moving averages, and then it'll move higher. So the 10 and the 20 period moving average for me are an excellent stop loss reference. They are a reference guide. They are not the end all be all, but they can help you stay in positions in trending environments for sure. So basically, the way I use them, like I said, it's a reference. And you're not just going to use a specific moving average on day 1 or 2 of the breakout. You're going to use your initial stop loss rules, but as you get into a move and a stock starts to show respect for a specific moving average, you want to start to pay attention to that. So for me, the rough general rule of thumb is 2 to 3 touches. Because let's say it touches the 10-day one time, and then it decides to consolidate a little bit more, and it shows you that it's a 20-day moving average type stock. It's not a 10-day stock. It wants to move a little bit slower. I don't want to just lose that position because it loses the 10-day. I want to give it a shot to hold the 20-day. Now, for me, generally, if a stock's not going to hold the 20-day, I am not going to be in it, not because it's broken per se, but just because I think I can probably find another stock that will hold the 20-day. So moving averages, we want to start to notice and track which moving average a specific stock is going to respect. And as we get further into the move, if we lose that moving average, we want to exit the position. So you'll see I say the further into a trend a stock gets, or the more touches a moving average has, the more relevant it's going to be. Why is that? If a stock holds the 10-day, 4 times, that's 4 times that everybody in the position has noticed that, and they're more likely to sell if the 10-day is lost, right? Now, if it holds the 20-day 4 times, now those people have got to see the 20-day support their stock 4 different times. And if it loses that moving average, they're more likely to sell. So it's important to, 1, follow your initial rules to protect your principal capital, and get to the point where you can see which moving average even matters. Because like week 1 or 2, we don't even know. Like the moving averages haven't even let us know what's important. But as you get to week 4 to 6 or so, now we should have an idea as to which moving average is important. Oftentimes you'll have a trend line, which I'm going to go over next, that actually sort of lines up with a moving average. And then we can, track that moving average as something of relevance. So in the O'Neill Disciples book, which I've mentioned before, that I highly recommend buying, reading, and referencing, right? I keep it on my desk. It's literally right here. Trade Like an O'Neill Disciple by Gil Morales and Chris Catcher. They have something that they call the 7-week hold rule, where once a stock has held the 10-day for 7 straight weeks, when it breaks the 10-day and then breaks the low of that day, you get stopped out. Up until that point, they use the 50-day moving average. So my approach is, not the same as theirs, and that I don't have a specific, 7-week number. But I am aware that if something's been holding the 7 or the 10-day for 7 weeks, having read their book and understanding that they've back tested this, then when it loses that 10-day, I don't want to be in the stock anymore. So I would say that this strategy is mostly going to come into play, or it's really only going to come into play when you're buying a stock out of a sound, non-extended base. So I'm talking like a 4 to 6, maybe even longer term base. And the stock actually has an opportunity to trend. If you're buying, like a bull flag, or for example, like let's say you're buying this wick play in Tesla, like the buy area is down here, as far as using the moving averages. So this is, more of a swing trade, whereas this is, for me, your quote unquote position trade. I get it, a position trade for me is shorter term. But so you can't, say, hey, we're only a week into the move, when really you're 4 weeks into the move if you buy here. So this is really to be applied, from the initial sound base breakout area, not more of a bull flag later buy area. So I want to definitely highlight that. But so this is great if you're, in a trending market where stocks are going to work up the moving averages. I mean, you'll see examples where stocks trend up the moving averages for months at a time. And with this strategy, you can hold those positions through those pullbacks. Now, in choppier markets, the moving averages become less relevant, because stocks just aren't trending. And that's just, the downside to this strategy is, sometimes you're going to give back in those choppier markets and then get stopped out. And that's just how it is. No strategy is perfect all the time. But if we look at this NVIDIA example, this is literally the, trend that we just had in NVIDIA. And I don't show the whole base here, but I've showed it on previous sessions, where it broke out, right in here around 208 to 213 or so. And what happens? We trend up to moving averages. Full disclosure, I really exited this thing right in here. But if this was your strategy, you have your first extension, which I'm going to talk about extensions, here in a moment, and then we pull back and we test the 10-day. And then we move up, and to me, you have your second extension, which, I'll talk about that as well. But then we pull back and we hold the 10-day again. So that's the second time. We move up and, we pull back and bounce here. To me, that's like a third test, right? And then when we lose this 10-day, to me, if you didn't sell one of these extensions, this is kind of your safety stop, your exit safety stop. You're going to exit when we lose the 10-day moving average here. It's also noteworthy that, to me, you have a trend line here. So you have 1, 2, 3 touches of the trend line. And then if we were also to look at the weekly chart, you'll notice that this second extension relative to the 10-week was, 20%. Actually, I think it was about 30% above the 10-week. So like every other thing that I talked about on the buying side, where you want to have multiple arguments, you also want to pay attention to the multiple arguments on the sell side. In this instance, we decided, if you were using this strategy, we decided to use the 10-day. We got our 3 tests. Oh, we also see a trend line. That's kind of argument 2. Oh, we're also extended from the 10-week. We've got a second extension that, we want to be aware of. And then when we lose this moving average, like, we can sell this thing with conviction in the sense that we're likely making a good decision. So this is an example where the 10-day is defined. And notice how early in the trend we're respecting the 5-day. I think the 5-day is more used to just judge character. I wouldn't be using it, to as a stop, because I just think it's too fast. But it's quick above the 5-day at the beginning, just showing you, hey, this stock's, it's pretty strong. Like, we might be in a good stock. But you're really kind of waiting, to see these tests, before you're going to define which moving average you want to use. So this is an example in NVIDIA, which it remains to be seen, whether this was a good decision or not, because NVIDIA hasn't really, fallen apart yet. But I would say that from a momentum standpoint, at this point, the trade is over in NVIDIA for somebody of my time frame.
Perfect. Let me see if there's any questions on this particular slide. Yeah, this is a good one. So when you're using the 10 and 21, the 10 and 20 EMA as your stop loss, are you waiting until the end of the day to act on your stop loss, or is it intraday when it breaks that level? That's when you exit.
That's a really, 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 really good question, and I expected that question. I use my discretion in the sense that I want to try to give it to the end of the day, but I also want to look at all the evidence, right? So in this specific instance, I almost think you could probably have sold this on this day, actually before it lost the 10-day, believe it or not. And the reason that I say that is we've got the second extension, which I'm going to go over why this is significant in a little bit, so I'm not going to harp on that too much. But then there's a couple other subtle details that I'm also going to go on later when I get into the candles and stuff like that. We've got our second extension, and then we kind of have like a breakout here that then, fails. I wouldn't call this like a failure, but it doesn't follow through, at least, right? Showing that buyers don't want to further pay up. But buyers do support it on the 10-day. But then is what happens, and you're going to notice this a ton in growth stocks near the end of the move. You're going to have kind of like, really, red flag number 1 is right here, where we have a gap and trap, but then buyers support it. Then red flag number 2, you have a second outside reversal. So this is an outside reversal. This is an outside reversal. Then red flag number 3 is when you don't get follow through here. And then red flag number 4 is, notice what they do here. They gap it up and they sell it. And you're going to see that. I'm going to go through so many examples where you have like 2 or 3 kind of, hey, I want to pay attention to what they did here. And then oftentimes that kind of fourth, I'll call it like dagger in the heart, is they'll gap it up and sell it. And another thing I learned from Trader Florida, usually a stock will give you 3 to 4, signs to get out. And it's not so much that you want to act on signs 1 and 2, but you want to notice them. So again, sign 1, sign 2, kind of sign 3, and then usually sign 4 is going to be the one you want to act on. And so this gap up here, I think when you start to see it go red to green, you can exit the position. Now, alternatively, you could wait and say, hey, I'm going to sell when it loses this day's low right here. That's kind of what they talk about at O'Neill Disciples with their 7-week hold rule. For me though, I choose to exit earlier, but only when I see those 3 or 4 signs. If we start to lose the 10-day, say like right in here, like right here, when you've really only had kind of one, you know, chink in the armor, you probably want to try to wait it out. But once you get those 2 to 3 signs, then I think you want to be, a little more trigger happy and selling.
Absolutely. And there's actually an interesting question earlier. It might not be completely relevant to NVIDIA, but do you have kind of a name for an Ignite bar to the downside? Like we saw a pretty strong selling bar in Tesla earlier, and it seemed kind of like a changing character at that moment.
Yeah, so I don't know if you're talking like in a downtrend. I would consider it like literally an ignite bar, but just to the downside. But another thing, which actually I didn't put in this presentation, but is something that you definitely want to pay attention to, and maybe at the end of the session I can go through and show you a couple examples, is something called a 3 bar break. It's something JT from Ticker Monkey taught me, and it's really when you have a bar that encapsulates the price action of all 3 bars in one. That to me is a major red flag character change. I can show you a ton of the stocks that have been smoked lately that all had 3 bar breaks. Some of those 3 bar breaks weeks in advance of when they, like, if you go look at Asan, we'll look at Asan at the end
Yeah,
of this, and I'll
yeah,
show you it had a 3 bar break, and then it went a little higher, but it couldn't break out, and then it sold off. But the writing was on the wall about 3 to 4 weeks earlier when it had that 3 bar break, and so a 3 bar break is something you want to pay attention to. And it doesn't always mean the stock's going to sell off right then and there, but to me it means that you've had a huge change in character in the stock, and the stock is unlikely to really continue to advance in a meaningful way. Maybe it takes at the top of the 3 bar break by a couple percent, but it's you're playing with fire once you see that 3 bar break in the stock.
perfect. I'll make sure to that we cover that at the end.
Yeah, absolutely. That's important. Thanks
Yeah,
for that question, because I didn't include that here, but it's something that's very important to pay attention to. Okay, so then trend lines. So I definitely use trend lines. There is an art to drawing trend lines for sure. I think that this comes with practice, with experience, like everything else. Um, but one, just general principle is a trend line should have at least 3 touch points. Um, so, a real trend line, again, sort of like using the 10/20 EMA strategy, it doesn't come into play that often because it takes time for the trend line to even develop, right? But it can be a great tool to help get you out of multi-week trends that have had 2 to 3 pullbacks, which define a trend line. So I don't know if any of you guys took, seventh, eighth, ninth grade math or so when I can't even remember what they call the line, but when you have a data set and they want you to draw a line through the majority of the data.
line of best fit. Yeah,
Exactly.
yeah.
So sometimes you sort of have to do that with a trend line. So you'll notice here the way that I drew this on Roku, I sort of drew through this little area here, which ideally I would like to connect the lows. But if you look at this, we touch, really to me almost 1, 2, 3, 4, 5, kind of 6 areas, and we do our best to touch all the lows. But in reality, this is the trend right here. Like I think that's probably clear to most people on here. But in this specific instance with Roku, I would say around right here, when this continues higher, like at this point, so not not here, but at this point right in here, when we, come back up off this pullback, to me, we know we have a valid trend line and that we've got kind of one area, two area, three areas, and we could have easily come back here and kept going and we keep riding this trend. But you'll notice multiple, kind of red flags here prior to breaking this trend line. One being um, some different candle combos here. Um, this just is not the best price action. It's not bad price action. It's just kind of like, oh, we didn't follow through. And then this almost looks like a flag, sort of right here. And they, kind of sell into it. This is sort of a false breakout. It's not on volume though, again, so it's not a major red flag. Um, but it's just kind of something to pay attention to. And then a gap down again is just kind of like, well, that's not great. But it finds support, so it's no big deal. But here you'll see they traded up, and it kind of closes like what I call a spinning top. It's a candle, thing to pay attention to, which we'll go over. But then after all this evidence, you get this big outside reversal on volume, and to me, and I actually did do this. I sold my position on this day, and actually I had bought some more right in here, and then sold the whole thing. But then we break this trend on a gap down. If you hadn't got out yet, I think you want to get out on the gap down. Even though you might be selling it down here, you're losing the trend, and many times you'll see this thing could have just blown all the way down to the 200 day. It did happen to put in a crossback, but this is a wedge drop right here, and then it has a crossback with another outside reversal and moves lower. But the point is that you define this trend, and then when we break it, nobody knew how low Roku would go here. It didn't matter. Oftentimes they'll just rebase and go higher again. But the trade is over when you lose this trend line if you're using the trend line as a sell signal. And oftentimes a trend line will marry up with the moving average that you're using to sell. In this case, it would be the 20 day. And the reason being is because the trend line is literally created off of price action, just like the moving averages are created off of price action. So in a tighter, more refined trend, like we saw with Nvidia, the trend line is marries up with the 10 day, whereas in this instance where it's a looser trend, it marries up with the 20 day. So often the trend line is just like sort of another argument, when it comes to executing on the moving average strategy. But it's important to utilize it just to kind of have more reasons as to why you're making the correct decision.
And do you draw these trend lines on a daily chart primarily, or will you also draw them on a weekly chart?
Yeah, I'll draw them on a weekly for sure. Absolutely.
Cool.
I may on the weekly, maybe on the weekly I've taken, 2 to 3 different daily chart trades, but I'm drawing the trend line on the weekly so that I can see like, hey, this stock on this higher weekly time frame is healthy. I can still look for daily area, bases to trade on. But yeah, trend lines like anything else, they're all this stuff is valid on all time frames. Just as you work down in the time frame, understand you're going to have more signals, which means more areas to execute and also more whipsaws, and that's uniform for anything I talk about.
Perfect. And could you talk a little bit about whether you use log scale or arithmetic, and also kind of why you've chosen that?
So I use arithmetic charts. I don't use log scale charts at all. And the reason being is because I think that's what most other people use. And in reality, I'm trading against other people because I'm trading against all the other buyers and sellers in the market. And I think I can analyze, the action better than them, or whatever you want to call it. I want to analyze what most other people are looking at, and I think most people are looking at arithmetic charts.
Perfect. I don't see any more questions. Oh, here's one good one. Do you draw like kind of parallel trend lines at any point? Obviously, you do draw your kind of channel, which we talked about last week. But yeah, can you talk about that?
Yeah, so I do think drawn channel lines. So like here, you'd probably have a line drawn up here in some way. And that can also be a good area. For example, we as you get later in the trend, these extensions will often kind of peter out at the channel resistance line. So if you think we're having a second extension and you're starting to see a red flag type action into that channel resistance line, maybe you can be more proactive in taking some off the table before you even see the break, kind of selling into strength. So channel resistance lines are definitely something that I use. I would say it's, more of an advanced technique, something you can definitely read about and how to make money in stocks. I think he generally uses I want to say it's the fourth breach of that channel line. And actually, there's a really good example that I think is going to play out of a fourth breach on, to me, the strongest stock in the market right now, being Apple. That's taking place, literally right now.
Perfect. I don't see any more questions on trendline, so I think we can move on.
All right. So extensions. So everything I've gone over so far as selling with the 1020 EMA and the rising trend line, to me, those are really, protecting you from losing your position, or from, losing your profits before the stock really falls apart. But none of those are really, selling into strength, right? So selling an extension is selling into strength. And I think it's definitely something that's important to incorporate into your approach, because oftentimes with growth stocks, if you're not selling into strength, I mean, you could be giving back a third to half of your profits by the time your, protection exit stop losses hit. So what is an extension? I'll tell you what it is to me. When a stock stretches to an extreme from the 10 EMA, they're likely to snap back. So it doesn't mean that a stock is, topped or anything like that. It's just the idea that when a stock gets a little bit ahead of itself, it's likely to pull back. Now, there are some extensions that should be more aggressively, quote unquote, sold into, and some extensions that maybe just, hey, I want to temper my expectations that this thing's just going to rip higher. It's likely to, consolidate a little bit first. So that being if the stock is very extended from the 10-week moving average, and it's also extended from the 10-day moving average, you want to more likely be proactive in at least taking some profits off the table. Whereas, if it's just extended from the 10-day, so for example, if we look, this is that same chart in NVIDIA, but I put the weekly here and the daily here. Right here on the daily, maybe this bar, and at the time, it doesn't now, but at the time, it might look a little extended from the 10-day, right? But on the weekly, it's like just breaking out, so it's not really extended. Whereas right here, which is about here, hey, we're a little extended from the 10-week. But it's really like the first time we get extended on the 10-week. But then right here, we're up here, we're about 30% from the 10-week. That's pretty significant. in the sense that we're extended from the 10 week and we're having our second real extension from the 10 day, you probably want to be taking some off the table. I'm not saying sell your whole position here. I would say if you're using margin, which I'll talk about later, you should definitely be taking some off the table here. But maybe you take some off and then you utilize your exit stop loss to take you out of the position. Um, and you know what? This isn't perfect. Sometimes in trending environments, you may reduce into strength only to see the stock move higher. I can tell you myself in NVIDIA, I basically took my position off here. I've traded it since, but it continued to go higher, and that's just how it goes. But I will say the second extension often leads to a basing period. And the third extension, if you get there, I can show you some examples from last year where we even got a fourth extension. Twilio comes to mind where we got a third and fourth extension. But generally speaking, the second extension will often lead to a basing period. And definitely the third extension for me, the third extension, I think you can sell your whole position, for me at least. But that's very likely to lead to a basing period. When I say a basing period, I mean, somewhere in the range of, 48 weeks or something like that, which for me, I just don't like to hold through that stuff. So I want to exit my position. But the percent extension, because I know this question is going to come up, is at your discretion. And again, it comes back to the personality of that stock. If we're trading a low float, high flyer, it's likely going to get further from the 10 week and the 10 day than if we're trading, something like Apple or, something like Procter and Gamble. So you got to take that into account. And actually, at the end, again, Richard, remind me, I was given kind of a study that's been done on this, looking at different types of stocks, large caps, mid caps, small caps, and roughly about how far they get from the 50 day and the 200 day. So it's, not the 10 day. But the numbers are about what I would expect. Generally speaking, on like a more liquid large cap stock like a NVIDIA, or something like that, when you get like 30% above the 50 day, which is about equivalent to the 10 week, the stock's likely to peter out. The best case scenarios will be about 40 to 41% above. And I think the worst case scenarios would be like 25. I'll show you guys the numbers at the end. But those are kind of rough levels to pay attention to. Whereas like a small cap high flyer, I can't remember the number off the top of my head, but we'll look at it. That number is going to be much, much higher because the personality of that stock is the thing can just absolutely explode. So the percent extension from the 10 days at your discretion, and you have to take that stock's personality into account.
Perfect. Let me see if there are any questions here. Do you try to correlate the extensions with the overall indexes at the same time?
Yes. So, for example, if I think that the stock is going to be, or if I think the index is going to top out, I'm going to be more likely to, if I see the index breaking down and topping, I'm going to be more likely to, take gains on an extension in a stock that maybe I think has been one of the strongest stocks. But, I think the index is breaking down. So maybe that second extension is literally going to be the top for that stock. So yeah, you got to take the index into account. If the index is breaking down and your stock is putting in a second extension, that second extension will likely prove to kind of be the top for that stock. So you definitely want to be paying attention to the index to a degree.
Perfect. And I thought this is a really good question from Steven. Any differences in handling extensions with an earnings gap up case? He struggles with handling trades that start extended from the 10 week because you do have that initial gap up.
Yeah, so I struggle with this to a degree too. The best earnings gaps are naturally going to be coming like out of sound basing patterns.
Right.
Sometimes a stock can gap up so much that it is, pretty extended already. Um, now the catch 22 is some of the best earnings gaps to play are the big gap ups. So it's tough to have hard rules on that. I would say that generally if you get a massive gap away from the 10 week, it's often going to consolidate a little bit to at least allow the daily moving average to catch up before it starts to move higher. So I don't have any hard rules on that. I would say generally though, the stock is going to base some until at least the daily moving averages catch up. Just because exactly what you say, it's extended. And actually I got these
Numbers.
This is the thing that I'm kind of looking at right now. I'm not positive where exactly this came from, but a member of Ticker Monkey posted it, and I'm kind of reviewing this to just kind of incorporate into what I already do. It uses the 50-day and the 200-day, and I'm not positive exactly what what the rules are that qualify as a small cap versus a large cap leader. But these are good rough general rules of thumb. I generally trade more liquid type stocks, so I'm probably a little more interested in these numbers. But let's say I'm trading a name that has a smaller market cap that's more of a high flyer. I pay attention to these numbers. I'd say these numbers are much more like you get 146 versus 79 versus 41 versus 29. I mean, they're much more variable, which sort of makes sense, and that the overall movements of these types of stocks is much more variable as well. So this is just some numbers that I'm kind of going through different names and studying myself to just get an idea as to how valid I think they are. But based on what I'm seeing so far, I think they're pretty valid. And I think if you were to go back and look at some things like NVIDIA, Tesla, etc., from just even this recent run, which I've been doing, they pretty much confirm what I'm seeing here so far. But I'm actively doing this review right now. But these are some numbers to consider for yourself when you're looking at these extensions.
Perfect.
And again, I don't know everything that went into what they defined as a small or large cap, but that's just a rough guide for you, I guess. All right. Okay. So next would be something I call a mini channel, or I learned this from Dan Zanger. He calls it a frozen rope. And I don't know how he defines it, but the way I define it at least is it's a multi-week move with very low volatility that to me just becomes obvious to all participants. So it's an extremely kind of tight, quote unquote, frozen rope. And to me, when these do break, you can get very, very quick profit taking. So I think, this is more of an example where the whole move is with very low volatility. But I'll show you some examples when we go through the examples where at the ends of moves, you'll often see stocks kind of accelerate near the end of their move, or they'll just show accumulation every day. They'll almost start riding the 5-day like this. And when they break, you can see like very, very, very quick unwinds. So this is just sort of like a tool to be aware of. I don't think you see frozen ropes all that often, but when you do see them, you want to be aware because when they break, you can get very, very quick profit taking. And that's kind of what we see here in AMBA. So I went over this example in AMBA where we, got in this range and it started working higher, and then this frozen rope was defined, this very, very, very tight channel, where you have this becomes obvious, right? It's not like this isn't an obvious pattern. They can go on for quite a while, but when they do break, I mean, literally, AMBA loses 10% in one day. And they usually do break with like a gap down like this or something, where maybe you have a big frozen rope, you get a downgrade, or something that's really insignificant. But for whatever reason, the stock trades down big. For me, you want to be quick taking your profits when these frozen ropes break. Like literally, maybe like pre-market or right on the open, just get out of the position. So not something that I think you're going to see all that often, or something that I think you should be the main thing you take away from today. Definitely not. But when you do see them, be aware that when they break, it can lead to some significant profit taking. I even think you can see situations where the whole thing completely unwinds when that frozen rope breaks. So I'm not going to spend too much time on this because I don't think you see them that often, but just be aware.
Perfect. I think this would be a good time to take a break, Oliver, if that works for you. Yeah, does it work?
Yeah, absolutely.
Cool. So it's 12:17 right now. We'll come back in, let's come back at 12:25.
All right. So next, I would say risk reward selling, and then another thing that I just call sell some, hold some. And so I'm gonna go over kind of the three areas, where you should be considering risk reward selling. So one would be, selling like an initial quarter or third. I read half here, but really like a quarter to a third, in my opinion, of your position within the first 3 to 5 days after a breakout. Probably at like 3 to 5 times your initial risk. So if you're risking like 1 to 3%, this is kind of selling in that 5 to 10% range. I don't always do this as much personally. I kind of take it on a more of like a swing trade, a later term trade, if you will. More likely to be doing this where it's like from an initial base breakout, where I think there's a chance for a real move. I like to try to hold my position. But I do think it's something very valid to do. I think it can help pay, for your initial risk if that breakout does end up failing and not working. And I think it's a very, very, very valid concept, that many people should consider. But then too is as the trend progresses, if you start to see red flags or early signs of distribution, it may make sense to further reduce a third to a quarter of a position. So for me, this is when I probably start to take off like a third or so of a position. And it's really just to assure that you bank some money pretty much, on the trade. And then lastly, you can sell your final piece, or the core, if you will, of your position into an extreme extension. So for me, this would be the second extension, or get stopped out on weakness on the loss of a rising trend line or the 10-20 EMA, depending on what strategy you're implementing. So kind of the same way for me with that initial or the three types of stops. You've got, kind of your max pain, then your breakout day, then kind of your break even, and then you're trailing it up. On the sell side of things, you can have kind of your initial just call it your risk covering sell. And then two, you would kind of have your, let me take a piece off into strength, sort of just because. And then three would be, I'm exiting my position. Um, so those are the kind of things that I would say there. And then two other things to touch on here is, I know some people use margin. I certainly wouldn't tell people to use margin, definitely not. But if you do, if you're trading with margin, you have to sell some of your position into strength. Like, definitely, I from in my opinion, I sort of view margin as like the cherry on top that allows you to reduce your returns. Um, but it's a double-edged sword, right? It can cut both ways. So kind of the general rule of thumb is sell margin into strength and equity into weakness. So be proactive in taking the leveraged part of your position off, so you can sort of let that non-leveraged portion of the position have more room and work for you. But the last thing you want to do is, have a bunch of margin on and add another position, and then like they all stop out, and you're, giving back a lot of your gains. So, definitely if you're going to be using margin, which again, I'm not advocating anybody do that, but if you do, I recommend definitely selling a portion of your position into strength. Now for everybody else, this kind of third concept on this page is, what if the stock gets so far from my stop loss that my open exposure is too high? And it's what I mean by this is, let's say a stock gets real extended from your stop, and you're going to give back like 30% of your gains or 20% of your gains, before you're stopped out. One, I would say this often aligns with an excess extension. So just take that into account, and is that oftentimes it's an area to be reducing your position, strictly just by working the strategy. But then two is if you have a stock that is 20% above like the 10-day, and it's we're 6 weeks into the move, and you think realistically, if everything works out perfectly, like maybe I can make another 20% or so. That whole risk reward equation is not in your favor at that point anymore, and that you have the potential to take as much heat to your stop as you do for even future gains if things work out perfectly. So to me, you want to take some of your position off in those situations, strictly to kind of keep that risk reward relationship in balance. So for me, I say, sell some, hold some. And what I write here is, if you determine that you're going to give back an excess amount of gains relative to what you think your potential upside profit might be, then it makes sense to reduce some of the position to continue to keep the risk reward relationship in your favor. So this generally always lines up with an extension. But I would say, let's say that you have a lot of heat that you could take on your position and you have yet to reduce any of the position. It probably makes sense to take some of that off. Now, if you've already taken off and reduced your position into strength, maybe you're in a position where you decide, hey, because I've booked some profits, I'm willing to give the stock that much room. That's fine. But I guess is what I'm saying is, if you have a full position and the distance to your stop is so large, that it doesn't justify holding that full position, put that sell some, hold some approach into work, and book some of those profits.
Perfect. Let's see if there's any questions real quick. I don't see anything specifically with this. Oh, here's one. Um, the problem with most traders is that the stocks all go down together. How do you handle if you have five positions and three of them have already hit stops? Do you readjust the stops on the remaining ones? I guess is the question.
If you have five positions and three have hit their stops. So, I mean, I try to treat each position on its own merit, in the sense that I think if I'm trading each position correctly, it's going to be okay. The thing you want to be careful of is, let's say that you have, three or four positions on, and they're getting extended, and then you add a fifth position, right? But you've got open heat on those three or four positions. Let's say that those three or four now pull back and you get stopped out on those and you give back those open gains. But then that fifth position, you also give back principal because it just never works for you. That's what you want to be careful for. So you want to be aware of what your kind of overall open risk is, and take that into account when it comes to kind of starting new positions. So let's say that you have a lot of exposure. Maybe you decide, hey, I'm not going to start any new positions until I get the opportunity to raise my stops on what I already have, because you don't want to put yourself in the position where you start getting aggressive later in the cycle, and then you give back a bunch of your gains, by taking late positions and then getting stopped out of everything at once.
Perfect.
Okay, so candle combos as clues. So I do not like strictly trade off candlestick patterns, but I use them to help me just kind of analyze the stock. But I always use them within context of where we are in the overall price cycle, because to me, depending where we are in the price cycle, the movements may not matter as much. And then secondly, I always use volume for confirmation when I'm analyzing candlestick patterns. If you have a shooting star that's got literally no volume on it, it's not going to matter as much to me as if it's like a heavy volume reversal. So, secondly, here, and this isn't really candles per se, but heavy volume with little movement is generally stalling action. And then wide range bars, I say ignite bars, but just wide range bars on little volume is usually retail buying. And then I say it here again, but I want to emphasize that all candlesticks need to be taken within context of the bigger picture. Where have we come from? Where are we in the trend? How far are we from the 10-week or the 10-day moving average? Because all that stuff is going to tell you whether a candle matters or not. Sometimes a stock just isn't doing anything. It has a spinning top, but it's at an insignificant area. Whereas if you're crazy extended from the 10-week and the 10-day, maybe it's a sign that there's some stalling taking place, or buyers are unwilling to step up, and it is more significant. So always pay attention to different candle patterns based on kind of where we are in the move. And then secondly would be, do we have multiple concerning candles in a row, over the last few days or weeks? Because you'll see when we go through examples, oftentimes you'll have three or four kind of hey, take note of this type candles, versus, just one candle that reverses the whole stock and everything falls apart. It's usually over the course of a couple days or weeks that you start to see, more and more little bits of evidence, that a trend may be weakening or institutions may be taking some off the table. So pay attention to multiple candles is going to be more important than just one candle. Okay, so the different candles that I use, and again, I highly recommend buying and reading the book Japanese Candlestick Charting Techniques by Steve Nissen, because there's far more candles combinations than this, and he goes much deeper in it. But generally speaking, the doji for me is a very important candlestick pattern. Really is what it is the open and close are just about the same. So the stock may go up, it may go down, but it closes right around where it opens. And it's an indecision candle. It just means, neither party really took control of the stock. Neither the buyers nor the sellers really took control. So it could mean nothing, but it could mean something depending on what happens next. It's just a kind of a let me take note of this. A spinning top to me is sort of the same as a doji. It's just less significant. Maybe the open and close are a little bit further apart, but it's just kind of like an indecision candle. Maybe it means nothing, maybe it means something, but let's see what happens the next few sessions. And then the hanging man to me is almost the same, in that the open and the close are close to each other. Hanging man is when you have a move in advance and then you see profit taking, but they close the stock back up, roughly around where it opens. It can be, a reversal candle depending on what happens next. I think that these become especially important when you see like huge volume on the downside in the morning when they sell it off, and then maybe it floats up on lighter volume in the afternoon. It could be a sign that there was like a little bit of distribution taking place under the hood. But these are all just indecision candles. You start to see a couple of them in a row. You want to pay a little bit more attention to it. In and of their own, just on their own, sometimes they can matter depending on where we are. If we're really, really extended from the 10-day and the 10-week and we get a doji, maybe it's a sign that stock is kind of petering out. But, if it's just kind of taking place at any old random spot, it may not mean much. Then next would be reversal candles.
Oliver, can you go back to the hanging man example?
Yeah.
Somebody want to understand the kind of psychology behind that pattern.
So to me, the psychology is you had, profit taking in the morning, and then, it came back higher in the afternoon. And kind of like I said, if you go look a little closer and you saw huge volume on the down move, and then maybe light volume on the up move, maybe institutions sold the morning and retail, came in and bought it back up in the afternoon. And that to me is kind of how it builds, and it's what happens next that matters. So the thing with the hanging man to me, where it can start to unwind, is if you kind of get a little bit of a gap down that next session and you get like a downside wick, then it can lead to kind of selling coming into that stock.
Right.
So in and of itself, it's just an indecision candle. It's for all of these, it's kind of what happens next that matters. But that's kind of how I think about the hanging man.
Perfect.
And then next is the shooting star is just the market moves up very strongly in the morning, and it reverses back down. Often it closes roughly around where it opened, but it's just a sign that buyers tried to push the market higher, and then by the close, sellers kind of took control. and took that stock back down lower. So it's potentially a sign of distribution, especially if it's on volume. Um, this is a type of candle when you get very extended. Maybe it can mark the reversal on an extension. But again, you want to wait for follow through, and you always want to take it in context. I think I said earlier that I used to get shaken out of positions, or maybe 3 to 4 days into a breakout out of a sound base, they'd have a shooting star, but it didn't really mean anything. It was just some short-term profit taking. So the key thing is, time frames, right? Maybe that 3 to 4 day swing trader, this pattern's significant at that point, but that 3 to 4 week or 3 to 4 month type trader, maybe it's just a sign, hey, we may get a couple days of rest. So time frames with anything are always important, but that's the shooting star. And then the bearish counterattack bar, and the outside reversal. The outside reversal is actually a Western technical analysis term, the OOPS reversal, but it's really just a bearish engulfing bar. But if you go through Steve Nissen's book, he'll talk about the bearish counterattack, the bearish engulfing bar, the dark cloud cover, the bearish piercing. All of them are the same in some way, in that the stock, it opens higher, maybe via a gap, or maybe it's around the same opening price, and they either pierce the previous candle, or in the case of a bearish engulfing, they encompass the previous candle, which is obviously more bearish. I hate to use that term, bearish, but sellers are more aggressive in selling the market down. These are just potential reversal candles. Again, depending on what happens next, but you should take note of them. Kind of depending on where we are in the cycle and the overall trend, because they're just signs that something could be happening. So these are sort of the reversal candles that I use. But again, I want to emphasize, I'm using these within context of the overall price cycle and everything else we've talked about. They can just sort of provide clues, and I'll go through it. I'll show some examples on the price action, and we'll start hopping into the examples section.
Great.
All right, so signs of a weakening trend. You're not obviously going to see all these things when you see a weakening trend. These are just like little tips and tricks, clues to look out for. But the first thing is, when a stock starts to show relative weakness for multiple days in a row, this can sometimes be a major red flag, and should definitely be respected if it persists. So I'll give you an example from 2013. I was pretty loaded in this stock, NQ Mobile, Chinese telecom stock. It was like the strongest Chinese stock in the market. I think it went from like $8 to like $22 or something like that. And then, the market and other stocks were doing fine, and this thing kind of started to show weakness, which was very uncharacteristic of it based on the previous couple weeks. And then, sure enough, Muddy Waters came out with a report saying they were a fraud, and the stock tanked, and it didn't actually go to zero, but it might as well have, as far as I was concerned. But it was all kind of tipped off on the relative weakness it had shown for the 3 to 4 days prior. So when you start to see a change of character in a stock and it starts to show weakness, something might be up, and you want to respect that. 2 and 3 are just, when you start to see a stock, lose momentum relative to a trend line or a moving average, that maybe it's respected. It may not mean anything, but it may mean something. You just want to take note of it. It's just kind of like a change of character in the stock. and that, hey, we respected the 10-week for like 6 weeks, or sorry, the 10-day for like 6 weeks, and like now, like we're not necessarily selling off through it, but we're kind of trading sideways through it. In my head, I'd be saying, okay, like maybe we're just going to consolidate. But you know what? If we lose the lows of that consolidation, I probably want to check out, because this is a change of character in the stock. Then next would just be multiple candles, which are negative, which that'll make more sense when I start kind of running through some examples. But just 3, 4, 5, 6 kind of you know different types of candles relative to the previous couple weeks. You want to just take that and keep it in the back of your mind. Then top tails bar after bar, showing that buyers aren't strong into the close, or the price takes out the previous day's high multiple days in a row, but is unable to push higher. I think one of the concepts I talked about on the buying side of things is something that I call, like no sellers to the downside, or no sellers down low, where you're taking out the previous day's low and they buy it up, just kind of showing there's no momentum to the downside. This is the same concept with the opposite way around, and that the stock takes out the previous day's high, but they can't hold it, and it comes back down. Now, it's just a sign that buyers aren't stepping up. It doesn't mean there's anything wrong with the stock, but it does mean that we're potentially losing some momentum, and we need to be aware for the fact that sellers eventually may start to take control and push the stock down lower. So it's just something to be aware of. And you'll see number 7, I say the overall rate of change of the move has begun to slow down. A lot of that is created by things like 5 and 6, where the buying pressure just becomes less aggressive. So, I say take these signals in context of where we are. Like always, are these red flags showing up as the stock is extended from the 10-week and the 10-day? Yes. Okay, then like that's more relevant. But are we? I say this example a lot, and sorry for spelling error here, but are we seeing it? Shooting star at day 4 after a strong breakout? Again, maybe some short-term traders are taking some money off the table, and it's okay. So context, context, context with all of these things. But those are just kind of some little things to be aware of as you analyze the price action. Doesn't mean they should be acted on, but if we see a bunch of these things in a row and our strategy is to sell when we lose the 10-day, maybe when you start to lose the 10-day, you're more quick to hit out, because the weight of the near-term relative evidence speaks to you and says we're really going to blow through that moving average. So kind of the rough overall steps, if you will, of each trade. As we're working through a trade, kind of what's happening, right? So one, we've got our max pain stop loss below the shelf, helps us to determine our position size. 2, as the breakout really starts to work, we can adjust our stop to the breakout day low. 3, as we get follow through, that rough stop area moves to about break even. Then 4, I want to ask myself, where are we in the cycle? How do I want to play this? And really, you should kind of be knowing this before you take the trade. But is this a quicker swing? Call it like a cash flow trade, where maybe we're buying a bull flag on like a basin break when there's already been like 2 buy areas. Or is this like a top dog with a great entry, out of a 4 to 8 week base? That should help you manage the position correctly. Okay, it's like a swing. Okay, maybe we'd want to be that guy selling on day 3 or 4 into that, kind of near-term extension, because of where we bought it. Let's book some gains. Whereas if we're buying out of that sound basing pattern and it's been longer term, which is really what we want to be, using for the majority of our buyers, maybe we want to be a little more patient with that stock. So, like, what are our objectives for this trade? That the stock takes out the previous day's high, but they can't hold it, and it comes back down. Now, it's just a sign that buyers aren't stepping up. It doesn't mean there's anything wrong with the stock, but it does mean that we're potentially losing some momentum, and we need to be aware for the fact that sellers eventually may start to take control and push the stock down lower. So it's just something to be aware of. And you'll see number 7, I say the overall rate of change of the move has begun to slow down. A lot of that is created by things like 5 and 6, where the buying pressure just becomes less aggressive. So, I say take these signals in context of where we are. Like always, are these red flags showing up as the stock is extended from the 10-week and the 10-day? Yes. Okay, then that's more relevant. But are we? I say this example a lot, and sorry for the spelling error here, but are we seeing it? Shooting star at day 4 after a strong breakout? Again, maybe some short-term traders are taking some money off the table, and it's okay. So context with all of these things. But those are just kind of some little things to be aware of as you analyze the price action. Doesn't mean they should be acted on, but if we see a bunch of these things in a row and our strategy is to sell when we lose the 10-day, maybe when you start to lose the 10-day, you're more quick to hit out, because the weight of the near-term relative evidence speaks to you and says we're really going to blow through that moving average. So kind of the rough overall steps, if you will, of each trade. As we're working through a trade, kind of what's happening, right? So 1, we've got our max pain stop loss below the shelf, helps us to determine our position size. 2, as the breakout really starts to work, we can adjust our stop to the breakout day low. 3, as we get follow through, that rough stop area moves to about break even. Then 4, I want to ask myself, where are we in the cycle? How do I want to play this? And really, you should kind of be knowing this before you take the trade. But, is this a quicker swing, call it like a cash flow trade where maybe we're buying, a bull flag on like a basin break when there's already been like 2 buy areas? Or is this like a top dog with a great entry, out of a 4 to 8 week base? That should help you manage the position correctly. Okay, it's like a swing. Okay, maybe we'd want to be that guy selling on day 3 or 4 into that, kind of near-term extension, because of where we bought it. Let's book some gains. Whereas if we're buying out of that sound basing pattern and it's been longer term, which is really what we want to be, using for the majority of our buyers, maybe we want to be a little more patient with that stock. So like, what are our objectives for this trade? Then 5 is, so I'm not going to talk as much about those like kind of swing cash flow type trades. The rest of this is going to be more focused on our nice top dog base buyers, because those are really where you're going to make the majority of your money. Early in the cycle, raising stops as we reconfirm higher prices to below those consolidations. Be reasonable. Our goal isn't to lose the position. It's to let it work, but also protect our gains always. As we progress and certain moving averages get tested on pullbacks, what is the stock showing us? What's its character? Is it holding the 10-day? Is it holding the 20-day? What is the stock saying to us? Because like the stock is like talking to you with its price action. Let it give you feedback as to its personality. Is it a high flying small cap IPO that's riding, the 5-day moving average? Generally, the majority of my positions aren't. But if it is, like, listen to it. Let it tell you that. Or is it, an apple that just wants to chug higher, but maybe it's going to take 5 to 10 period little rests down into the 20-day before continuing. That's fine. Let the stock tell you that. But earlier in the cycle, resist the urge to take profits on that like 1 to 3 day pullback, because you don't even have any information yet. Like you don't even know, what's going to happen with that stock. Like what's it going to do? It takes time to have like a nice advance in a stock. It doesn't generally just happen in like a week. Obviously, there are situations where that does happen. It's generally in very, small cap type stocks. Okay, 7. As we get
Oliver,
deeper,
could we
yeah,
actually step back?
yeah.
So there's a really good question here from Jonathan with regards to number 4 and 5. When you evaluate where we are in the cycle, is it only the stock cycle or is it also the overall market cycle?
So you always want to be taking into account the overall market, all the time. Like if you think that we're later stage in the index, like, maybe you decide, hey, I'm not going to put any new positions on no matter what. Or maybe I'm going to put on, very, very small positions to kind of test the water. So you always want to be taking the index into account. But as far as managing your actual position,
Right.
you want to be trading the stock you're trading, not the index. So I know some people say to completely ignore the index, and I'm not saying like pay attention to everything that happens with the index. Definitely not. But I think it's something you have to be aware of.
Perfect.
Because at the end of the day, I mean, you see it in How to Make Money in Stocks. Like 75% of the stock's movement is driven by the index. So for example, this past week, if you were trying to buy breakouts, they were getting slammed in your face because the index was selling off. So you do have to take the index into account. Okay, so as we get deeper into the trend, has a trend line developed with 2 to 3 touches? Are we are we tracking a specific moving average? And again, don't like force this. Don't say like, hey, we're in week 4, like there's a trend line here somewhere. No, like you should see it. It should be there if it's there. And if it's not there, don't force it. Just start to try to look for that type of stuff to develop. And then always have context on the weekly. So number 8, are we getting extended from the 10-week moving average? If so, are we looking for a second extension on the daily to sell partials into? And it's what I mean by that is like, hey, we're getting extended from the 10-week. Like, okay, we're having a huge gap up in my stock this morning. Don't get excited. Like, that's probably a partial profit taking opportunity, just kind of based on where we are. So be aware of that, so that you can kind of better control your emotions when you see that gap up. Later in the cycle, are we seeing an acceleration in the price action? Frozen rope structure. All of a sudden, after holding the 20-day for 5 weeks, are we starting to see the stock respect a faster moving average than the majority of that run? And I say, e.g., the 5-day even. If so, we want to be looking to raise stops with the price action. So you'll often see this in some of your bigger winners where maybe you've been in the stock for multiple weeks or hopefully even multiple months. You'll start to see a change in that character of the stock where it starts to accelerate. And that is actually generally, well, one, it's great because you can you can even make the majority of your gains sometimes on that final, quote unquote blow off. Um, but it's also a sign that you may be getting to the end of the advance and you want to start to pay attention to that and recognize that changing character of the stock, and be aware so that you don't give back all your gains waiting for that original moving average that had respected the whole move. And I'll show some examples of that when we run through the examples section. Um, and then the last couple of things here, take your sell signals on a loss of the respected moving average or trend line. And then 12, if you don't sell that second extension or it doesn't materialize because it doesn't always show up, and maybe you even miss the trend line sell or the moving average sell, pay attention to the cycle because you will always get a wedge drop on a stock. You literally have to, and it can protect you and take you out of the trade. So I want to emphasize, like, you're never going to be perfect. I mean, sometimes you are, but you're never going to be perfect on every single trade, obviously. And when you're not perfect and you misanalyze and you miss the proper sell or whatever, don't be stubborn and think the stock's going to go back up to where you should have sold. When that wedge drop happens, let the cycle protect you. Just get out and play to live another day and take the gains you got. And then lastly, once a trade's completed and you've had a multi-week, trade, often that's going to align with the multi-week advance in the actual market. Be patient, let the market reset after a nice run. Things need to rebuild. Stocks don't just go straight up without ever consolidating. I think you read stuff, stocks consolidate 50% of the time. So be patient. After you make nice gains, you're unlikely to just make those nice gains in the exact same manner again, like right away. And that's, kind of the thought process from beginning to end, of a trade or a run, whatever you want to call it. So I just kind of outlined that there. So any questions on that?
No questions, but there were some comments about how, yeah, these slides really sum everything up. And like you said, with number 13, pullbacks and corrections set up the next batch of leaders. And it's always exciting to have that and have the new opportunities popping up. So it's never a bad thing for things to reset.
Yeah, exactly. So I've said this before. Trader Florida, one of his big things he always says is, corrections are great as long as you don't ride them down. So look, you can make good money short in the market. Oftentimes you can make more money more quickly, but it's like extremely difficult. And you get shaken out a lot, and it can be very frustrating. Sometimes the best thing to do is to just sit in cash and be like excited almost like you're about to uncover new opportunities. Like maybe the market topped out and we're going to sell off for 2 years, or maybe the market is just like going to consolidate for a month and we're going to get some awesome new opportunities to trade. And maybe they're going to be the same as the names we just traded, but maybe there's going to be new ideas that we didn't even know about.
Right.
So look for relative strength, like embrace corrections. They're awesome. You make your biggest money after a correction.
Right. Let's see. This isn't strictly related to this slide, but here's a question from Philip. Oliver, from your experience, what's your proportion of selling into strength versus selling into weakness, versus selling into a moving average or a trend line?
So I would say that I am learning better how to sell into strength. Like I would emphasize that I'm like a pretty young guy. Like I don't have all the answers. There's certainly people who have much more experience than me. I would say, traditionally I would more sell into weakness because I didn't have the skills that I'm developing to sell into strength. And hopefully getting better at taking my gains into strength. Um, but I do think it's valid to, you know, always try to hold at least a portion of your position where maybe you sell it into weakness, because I think some stocks can go a lot further than you expect. But I also think that, you know, when a stock is ready to be sold into weakness, it or into strength, sorry, it almost can sort of like be obvious um, if you just like wait long enough, where it just gets like so extended that it's very unlikely to continue higher. But sometimes when you sell into strength, you're selling into strength like far before that point, and that's just kind of how it goes. So I guess it's not an exact answer, and I think in a couple of years, if you were to ask me that again, I could answer it better. Um, but I'm getting better at selling into strength. I think in the past, I more kind of got stopped out on weakness because I just didn't have the skills.
Perfect. Yeah, I think that's most of the questions related to these slides, so I think we can move on.
All right, so we're gonna run through some examples now, and like many of these have been things we maybe reviewed in the buy sections and stuff, but I want to more talk about like the trade management this time. So I'm not gonna really talk about the actual buy areas because we already kind of did that. Um, but so this is UPST, and we had the Bible gap up, and so the thought process is here. If you were real aggressive, you could have played this day one. Um, but really, the actual buyer is to take out of the day one. So you take out day one, and your stop loss would be the low of this day. As we get follow through here, especially here since you have a gap up, gaps, as we know, big gap up equals strength, right? So this is like almost like an ignite bar. I guess technically it is. So early in the move here, I wouldn't be moving my stop up to here, mainly because like I want to see if this thing can work. But it's what I would be doing here is I'd probably be getting my stop up to like this rough area right in here. Just because we break out, we follow through. Like I don't really want to lose money on this trade at this point. But then is what happens is we consolidate. That's all fine, and then we get this wick play here, which could be a second buy point. So if you wanted to pyramid your position, or if you missed this and want to take an initial position, I'll call this position A. Once we break out here, you can move your stop up to below this consolidation. This is really just a reconfirming price strength confirmation. If you started a position here, your initial stop would probably be below this wick area, but then as it gets going, you want to have position B's stop at the day's low. And that is what happens. We move up, we pull back, and we base. And then when we reconfirm higher on both positions, position A and B, you want to raise your stop to below this price consolidation here. Now, this could be viewed as a buy area as well, and that you have a tight inside day, and we take this out. I would say kind of like after that second buy area for me, you can still take it for sure, but kind of after those first two areas, I think kind of buy area 3 and on should be treated more, for quote unquote like cash flow, if you will, more like swingy type stuff. Where maybe you're selling it like here or here. So I'm going to focus on buy areas A and B for the rest of this. But we move up, and we move up. This is an ignite bar. So your rough stop is right in here on this low. So you could have been shaken out here. Totally reasonable that you might have been. But for the sake of this, I'm going to keep going because I do think that this is kind of like a top dog stock. I think most people would agree with that. And at this point, you're still kind of learning which moving average it's going to respect, which to me, this is kind of the first rough area where it's sort of, shows it may be respecting the 10-day a little. It doesn't really test it, so it's not that valid. But here it tests the 10-day. Like, I think you want to be careful in a top dog earlier in the move before the 10 days even tested, because I do think the 10-day gets tested at least once on most real winners. You want to be careful just losing your position. But this could be viewed as a buy area here. I think it definitely is kind of through this area. But again, I view it more like a swing because it's just a little later in the move. But if you did buy here, your stop would be quickly moved to this day's low. Whereas your A and B's, you would adjust it to here, and then as we follow through, pull back. You want to raise the stop here, and then when we reconfirm, raise it to here. This ignite bar, based on where we are in the trend, I would definitely be adjusting my stop up, more aggressively than this ignite bar low because of when it's happening. And then as we continue to move up, we pull back, we test the 10-day again. So you've kind of got 1, 2, 3. I think the 10-day is starting to become valid here. And then start to notice some of the different types of price action here. So we did see a hanging man here, but it never confirmed, right? The next day it was up, showing to me that that initial selling pressure wasn't important. And then you do see, I guess, a bearish engulfing here. So those are kind of two, rough areas, but we really start to see a bunch of different signs here. We see a doji here after just kind of seeing what I call these empty wicks. When you start to get extended and you get these little wicks, I just call them like empty wicks. I don't know if that's actually a thing, but that's what I call it. Followed by a doji, followed by like another empty wick, a spinning top. And then notice how when we kind of had this like little 2 days of consolidation, there's other times in this move where we saw it. We saw it right here. We saw it right here, and we continued higher. But notice how we see it here, and they traded up, but there's no follow through. So like we're starting to just see some like slight signs of a weakening in trend. And then we definitely kind of see a shakeout here that holds the 10-day. But for me, when I see this bar, I'm thinking, okay, if we trade down and take this out, I'm going to view this as like a loss of the 10-day, and I'm definitely going to be getting stopped out. But what happens? Like it trades back up, which is great, right? But they close it off the highs. So now we're kind of seeing like 1, 2, 3, 4, 5, like 6 bars in a row that are just sort of like quote unquote, weakening bars or slowing rate of change type bars. We get another spinning top here, but then we kind of have a shelf built right here, which to me can be like your wedge drop shelf. And so to me, you would be stopped out on this loss of the 10-day here. And it does end up supporting and going higher. But you just never know when it's going to break and continue lower. And so to me, this trade ended for a couple of different reasons. One, I think the stock showed that it held the 10-day. Two, I think we had a defined trend line here with 1, 2, 3, 4, and this would be like the 5th touch break, all combined with the fact that you start to see just type of stallish, losing momentum type price action here. So, let's say that you got stopped out around, 315 or so, give or take. You caught a move from like 185 to 315. And to me, there was never like a ridiculously extreme extension here to really sell. Like this to me right here in hindsight was obviously the area to sell the stock. But I think at the time, I actually know for a fact at the time that I wasn't thinking that. But this is the break because of all those examples, and you'd be out of the stock. Now, I can tell you a lot of people I saw wanted to buy the 20-day pullback here. And I can tell you on this day, I actually bought it and just got rid of it that day because I thought this was a dark cloud cover that could have led to a negative wick. But I'm not as much of a fan of buying this pullback to the 20-day here. The reason being is that it had shown it was respecting the 10-day. And so to me, the 20-day wasn't necessarily as relevant because the stock had respected the 10-day the whole time. Now it did end up working, um, but that was my thought process, at least when I was trading this. So for me, the way I played this is I got back involved in this stock when it took out this trend line on this wick play here. And I actually tried it on this day and didn't hold it, but then I got back in it and held it on this day. So, the buyer is here, stops down here. And I think when it follows through, you get your stop to here. And really, when you get this ignite bar, you move it up to here. So this ignite bar is definitely relevant in that we're later in the trend. And then this was the second extension. Again, I didn't sell this. I didn't pick up on it at the time. But actually, when you go back and study this chart, and you look at the weekly and the daily, in hindsight, I think it was pretty obvious. But I think I should have seen this at the time. I think part of me was kind of thinking that, but I just didn't act on it. But is what did end up happening. We gap down, they support it. But then what happens? We get that, bearish piercing pattern. They gap it up and sell it. It follows through down. But this to me was the bar that I did notice a change in character on, and that we got this kind of empty wick extension type bar. We get the gap and trap bar here. That's kind of chink number 2. But then number 3 here is they traded up and back down, and for me, I exited the position when we lost this area because I kind of viewed it like 1, 2, 3, lose that 4, and it did pop back up here, but the trade was over. Like the momentum was gone. So that's sort of how I played UPST. It had one really nice trade, and this was actually a pretty good swing trade if you sold it correctly. But even if you didn't handle it great, you still made a little. And what happened on this bar here too is we lost this ignite bar low, which even if you didn't even recognize this, your stop loss would have taken you out down here. And that's part of the game. You made 6 or 7% or so. If you sold it correctly, you could have made a lot more. But again, none of it's going to be perfect. So that's kind of how I would analyze UPST.
I'm not seeing any specific questions on this chart, so I think we can go on to the next example.
Okay, so CrowdStrike. So this is like a trade that, like, I don't always want to show like the perfect trades because most trades are not perfect. So this was a trade last year. We had this basing pattern, and then what happened is this broke out on earnings. So this was a buyable gap up. So if you played this, you could get it on the earnings gap and probably add to your position here. Your stop loss is down in this area, and then when it follows through, you move it to this day's low. It goes up, it pulls back, it reconfirms. So what do you do when it reconfirms? You adjust your stop down to this area. And the nice thing is too is when it trades back up here, the 10-day comes in under the up bar. So I kind of view it like when that happens, in addition to this being that reconfirmation, you're also partially protected by the 10-day moving average. And then you get a couple tight price bar days. This to me is a valid buy area here. So we break out. If you were initially buying this here, I think an aggressive entry would have been this day. Another entry would have been this day. and you'd keep your stop either here or here, depending on where you played it. And then when you get this gap up, this is definitely an ignite bar because of the gap, especially when you get this follow through. So you raise your stop to this bar's low, um, and then it continues up. And to me, this is sort of like a short shelf where maybe you take some off the table, but it really is so early in the trend that it hasn't actually, this is kind of the point where you're trying to, like I said, you want to learn the personality of the stock and figure out what it wants to do. You're still kind of at that phase, because it's not always just going to pull back here. Like someday it's going to base and go higher, so you want to be careful choking this off. But to me, this is an extension if you look at the air to the 10-day, for sure. And so we pull back, we come up here, and to me, I treated this as a wedge drop, just how I felt about it. So if you exited here, you could re-enter. But if you decided, hey, I still want to wait and see which moving average we're respecting, it ends up showing you that the 20-day is probably more relevant. But if you took it off like me, this is the re-entry kind of on this wick area. And if you took this, your stop is this day's low. If you were still in the position, I would say once it takes this out, you're probably keeping your stop kind of down here. You could get it all the way to down here, but I would feel like if it lost this area, it's going to lose the 20-day anyway. So you keep it here, and kind of when it starts to move up more, both stops kind of move up. This to me is a reconfirmation right here, because you could have a line drawn across here. So we test that, we pull back, and when we take it out, you're reconfirming. So all stops would be moved up to this day's low. For this secondary stop, you basically adjusted your stop to protect your price, right? And then to me, this isn't an extension. It's just not, like, I get it in hindsight that this, is an extension, but it's more just a stalling in that this stock wasn't really ready to blow higher. And the thing is, this trade just didn't work that great. We pulled back to the 10-day. This kind of looks like a bull flag. It doesn't really have any momentum when you're going through. So a couple of things to highlight here is I do think, if you're right here and you're looking back, you're thinking, wow, they didn't really have the Momo to kind of send this thing like UPST where it trended. This is acting like more of a choppy stock. But then right here we have this shooting star, which you then get the big sell bar. Or it's not a bearish engulfing or anything, but it's that type of action, right? And then this bar as well. And then what happens? They support it, okay, but there's no real momentum out of this bull flag. Like if you were looking at this, you probably had a bull flagger and you're expecting a breakout. It just doesn't really go, right? And then this is a bearish engulfing. This is like a spinning top where they traded up and back down. And then is what happens in this. I can't emphasize enough. This happens so much. They gap it up and they sell it down. And that's the wedge drop right there. So you should be stopped out of this around 220. So if you had your initial entry and you held through this 20 period, you had a gain of, about 19, 20%. If you had it here and you sold here, let's say you made about like 10% and then you made, like 2%. And that's just how it goes. I mean, there were a couple different ways to play it. This wasn't that sexy 50, 60% winner. But in reality, you're going to have like maybe 5 to 8, 3 to 8 of those 50, 60, sometimes even much larger winners a year. And, a lot of your trades might kind of be like this. So it's important when you're going through and you're, looking at the hundreds of different charts and trying to trade them, that you try to be as honest with yourself as possible as to how you would handle it. Because, you can stack these types of, to me, not really like winning trades up, and they can really help your account. But like this is probably the type of stuff that people don't always show, which this is like kind of trading. It's like how you manage these trades that just like don't kill it for you. So that's how I would look at this CrowdStrike trade. So any questions on that, Richard?
Yeah, we have a few. Let me get that up. Let's see. Here's one from Emmanuel. Would that sell be based on the fact that it is a gap up slash reversal, or due to the cross of the 10 MA? I think it's the wedge drop.
Yeah, so I think this is sort of the wedge drop, and that we basically there's a couple things, right? We when we take out a level, like if a stock's going to trend, like it should go higher. So in reality, when we lose this kind of area, it's a quote unquote like false breakout. I don't really think there's a true buy area here to fail on, but when you don't continue higher, it's just a sign like there's not a lot of momentum, right?
Right.
And we want to be in stocks that have momentum and are moving higher, or like maybe it's better to just be in cash, because like when you're in cash, you're in safety, but when you're invested, you're exposed, right? Um, and we see this kind of inability to move higher, followed by some profit taking. I think you see more profit taking here. And then again, like this could be treated as a buyer and there's like no momentum out of it. So to me, when I see kind of like all of this collective price action together, I see just buyers that like are not willing to step up and move the stock higher. And then you do have a shelf here, especially in that you get profit taking here, in these last 2 days lows define 220 as an area of significance. So you get this gap up, you go green to red, and you take out this area of significance. That's a wedge drop to me. Now, does it follow through and fall apart? No, it doesn't. But in reality, even though this thing like goes higher and stuff, this is not like the one of the faster moving stocks in the market, most likely. And these sell areas kind of allow you to put your capital somewhere else. So some people will say, well, it held this support area and went higher, like, you're a moron or whatever. And like that's okay. Like I had my capital for something that was probably going to be moving a little bit quicker. So that's kind of why, like, look, some people use the 50-day and it would have kept you in, and I agree with that. For me, I use these moving averages because I think that I can get something better. But this all collective action is what defined this as the wedge drop for me.
Perfect. All right, there's some more questions coming in here. Here's a good one from Luigi. When you have the stop at the low of an Ignite bar, but then a pullback follows that triggers a stop, but it is still holding the 10-day EMA, which stop rule do you ultimately respect?
So I would say it depends where you are in the move. So like early in the move, like an Ignite bar is just like the beginning of the move, and you maybe want to give it more room. But if it's like coming out of a bull flag, like it's step 3 or 4, like I'm probably going to take the stop, because there's like an air pocket at that point where if it does fail, like you got more room to drop. Whereas early in the move, you've got more support kind of below the stock, if that makes any sense. Um, Generally speaking, when a stock is above its 10-day moving average, like it's fine. Like you want to try to give that thing the benefit of the doubt, but you want to take into account like where we are. Like if we're in week 6 versus week 1 or 2, you've got to treat it a little bit differently. Week 1 or 2, I want to try to allow that 10-day moving average to, help me. Whereas week 5 or 6 or so, where there's more of an air pocket if that thing fails, I want to be more defensive.
Perfect. And there are some questions related to whether you use any lower time frames for selling, kind of like how we did with buying, where you look for maybe a signal in a lower time frame within the context of an overall point on the chart where you might want to sell on the daily or weekly.
Yeah, for sure. So, let's say we've got all this evidence here, and um, maybe even right here, you decide to exit because the same way this gaps up and goes down, this kind of gaps up, and maybe you see on a lower time frame, it tells you that this is going to occur, and you exit. But when you see all this evidence right here that I've talked about, and you get this kind of gap up, really the stop's 220, but maybe you exit here when it goes red to green,
Right.
because it's just like you expect it to fail, and maybe you can assess and see that on a lower time frame. Sure, but kind of the same way as on the buy side of things, you want to try to avoid looking at that lower time frame unless the overall, like, bigger picture evidence tells you, like, hey, there might be a reason to kind of zero in on this thing.
Right, right. The higher time frames are always the most important, and the context is so important as well.
Exactly, yeah.
Perfect. I think. Oh, let's see. Here's one from Philip. It seems that the gap up and close red is a very strong negative signal. Would you sell in the post market directly when you see that type of action?
Well, the gap up would occur in the morning,
Yeah.
for one, and I would look. I'd love to say I'm good enough to sell in the pre-market, but I'm not.
Right.
Usually, I'm cognizant of the fact, like, for example, this could have gapped up
And
and
gone.
broken out, right?
Right.
But usually around like here, I'm gone. And I do think that you see this happen very, very regularly. And it's usually when you have kind of 3 to 4 to 5 kind of, you know,
Warning
types of things
signs.
that I've
Yeah.
showed you. Yeah. So, I don't know. There's probably people that could back test this or something, but I'm not really that type of guy. But I think that if you start to see stuff like this and you start to see gap ups that don't follow through, um, you want to be more aware of it, that it could be leading to some downside shake.
Great. I think we can move on to the next example.
Okay. All right. So Peloton. So one of the things I'll say is that your best opportunities that can lead to big gains are often going to be like stage one IPO based breakouts.
Right.
And look, I'm not talking about like your week 2 or week 3 IPO. I'm talking about your 6 month to 24-month type IPO breakout. Reason being is, like, no institutions own the stock yet, except, like, the ones that maybe got an allocation on the IPO, or I think we're seeing more and more companies now, get involved in stocks in the private market. But for the most part, all that IPO stuff, like IPO due diligence phase and stuff like that, that first 6 months, people are deciding whether they want to own the stock or not. And if they decide they want to own it, they're probably going to take multiple months to accumulate their shares. And when you get a stage one IPO that works, that's when you're going to get a big move. So I would say with these types of stocks in particular, try to in particular give them the room to really allow you to tell you what moving average they're going to use. So I'm going to analyze this, and this is also an example of that time stop. So to me, Peloton originally broke out right here. I believe, I don't see it here, but just off the top of my memory, I believe this price was about $28. Because I remember I was real fired up about this. but it broke out and it ripped, and I believe the top here is around $38, which was the actual IPO high, and it rejected it, and that's okay. It never took out the stop area, but what happened here to me, and I know this, like I got time stopped like right here when it kind of didn't fall through again. I was really disappointed actually because I thought this thing was gonna explode. Um, but I got time stopped, and it was more just because like it went, it pulled back, it held the breakout area, but then when it failed to reconfirm here, it was just kind of like like all right, like maybe this thing isn't gonna work. Um, but then you get another breakout right here. So it breaks out, your stop's probably below this area, kind of below the moving averages, and then when it kind of follows through, notice how it kind of pulls back and follows through the highs. You can raise your stop to this area, and then when it gets up here, you raise your rough stop area. Even though the early breakout was here, and that's probably roughly around where your price was. When it takes this out, like recognize like a lot of people probably didn't buy till like up here. So when it pulls back and goes, like get your stop up to this kind of rough area right here. Um, so what happens? We go up. I think an aggressive wedge drop was right here, but I think I know this was a stage one, so I was trying to give this room. But then this was the shakeout right here, where again I was like, gosh, this stock, I keep thinking it's gonna work and it doesn't. It shakes at the 20 and it closes higher. So to me, you get stopped out here, but I'm going to show you some more examples of this where it shakes the 20-day early in the move, and then it retakes it. And the old William O'Neill has this saying. He used it on the 50-day. But when a stock like shakes out and then comes back, I think it's within like a day or two. You actually want to like buy double your position, or you want to buy more. And I think it applies for me as well with the 20-day. And I'll show you other examples of this too. So to me, this is a re-entry on this shakeout. Like literally, like you're out in the morning and you're back in the afternoon. Um, and it goes up and it bases it holds the 20-day again. um, so when you re-enter here, your stop is going to be down here, and then when it falls through, you're going to get it right to this rough area. It goes up, it tests resistance, pulls back, and when it holds the 20-day again, you're now going to raise your stop to below this 20-day hold area. And to me, two tests of the 20-day, the 20-day is being defined as the moving average that's relevant. It's still early, but the 20 days like pretty much showing you that's what this stock wants. So this is like a cup and handle. You take this is a breakout. So you buy here, your stops the day's low. This does squat a little bit. The one thing here is it gaps down and it holds a higher low this next day. So to me, I would actually probably raise my stop to that gap down low. And I know the way I am on this squat day, I'm probably like, oh man, this isn't gonna work. But then is what happens is it firms up and it pushes higher. I'm raising my stop to kind of this rough area. So it's almost like this stock is taking like 5 or 6 days to get going, but the stop levels are holding. Um, and then it's working higher. I would have, I know I didn't, I would have never seen this bar coming. Like no way in heck. But it comes, we hold the 20-day, we kind of rebase. This could be viewed as another buy add area. We continue to hold the 20-day, and you could raise your stop to below this area. And then for me, this is the first area where you could have likely been stopped out. Well, I guess I showed the shakeout area, and you could get taken out here. Or often you'll find this breakout area will hold price, which is exactly what happens. So I would just say, you could try to hold through this because it never really definitively loses it. But if you do get stopped out, do not be afraid to buy the stock back, because that's often what you'll see is stop areas almost become support areas at the same time. And it's kind of a tricky game. And if you get it wrong, just buy it back. it's not an exact science, but that's how it is. The 20-day really pretty much continues to hold here. We go up. To me, this is a really good buy area, and that you get a gap up. This reminds me a lot of Tesla last year when you had that kind of I think it was when it got added to the S&P, where you're in a base, it gaps up, it holds that pivot high area, and when you take this out, this is a breakout. Your stop's the day's low. We move up. You get a hanging man this early because I think that this is a valid buy. I would not be looking to take gains here. I'd be looking to see where the stock gets supported. And sure enough, it has a big shakeout. It holds the 20-day and the breakout day low, and it moves back higher. Your stop would definitely be moved up to this day's low in this reversal. I can show you other examples of breakouts that occurred like this. NVIDIA's one earlier this year that was very similar. And to me, you're thinking here, wow, this is loose price action. This is not a good sign. That's just flat out. This is not a good sign. The one thing that occurred here, though, with Peloton is the market was actually correcting when this was happening. So you're getting loose action, but it's actually showing relative strength to the overall index. So it's tough to really show this stuff because we're not looking at the index too. But it continues to hold the 20-day and show that character. And then to me, this is another buy-add area. And the reason being is because the index starts to kind of come together here too. So it breaks out for your initial, if you have been able to hold in through here, your stop's coming down here. If you bought here, your stop's here. If you're playing this buy area, your stop would be this day's low. And as it works up, for everything, even this stop down here, you're probably moving it up to here. When you get this pullback and reconfirmation, now you're trading all the positions together. With your stop down in this area, I think like taking this out, it's not tight. It's not a real buy area. I think you got to be careful buying stuff like this extended. Even though it does work here, it just is not a buy area. It's extended from the 10-day. But basically, when we take this out, you're reconfirming. You pull back, you take this out again. To me, you're reconfirming again, and you're raising your stop to this. And then after holding the 20-day, this whole move is what we start to see through this. This is like basically sort of like a frozen rope. It doesn't create like a tight channel, but it's the concept of a frozen rope where you can draw a line here and here, and it's tight, low volatile action, where after holding the 20-day for like months, we start to see it show a change of character and hold the 5-day. And to me, when you're getting this, you're pulling back and you're reconfirming higher. You're getting an ignite bar here. This is an ignite bar here. And then to me, you're stopped at right here. When you lose this acceleration and we create a short shelf here, and then you get a doji, you get an ignite bar with little volume, you get a bearish piercing. This tests this shelf again, and it kind of defines this level here. And then when you get this bearish outside reversal, I think it'd be totally fine selling at the low of the day here, or the shelf if you're very aggressive. But you can kind of see the change in character here, which is something you've got to pick up on as you get later into an advance in a stock. Early in the advance, like right here, it could just be a sign that a stock is being accumulated. But later in advance, multi-months, like this is like month 4 to me, it's a change of character to what the stock has done the whole time. And you need to pick up on that, because then the stock, sort of falls apart. And then you get real loose price action, which this was a buy area, but I think I showed you on the weekly, you could really see how this total basing structure was much different than anything else we saw in this stock the whole move. And this is kind of when look, I get it, it went higher, but this is sort of when like the healthiness of the stock changed when you got stopped out here. So that's kind of how you could analyze Peloton. And Peloton wasn't easy. I mean, there were definitely areas where you could have been shaken out of this. Like I know I was shaken out of this and rebought it, definitely here and here as well. Um, so that's kind of part of it. Like I was shaken out here and I got it back here literally about the same price, which like I get it. Like I'd like to not do that, but you just never know when this buyer is going to roll over. You just never know. So that's I'm okay with that.
How do you usually handle times when the stock is so volatile, but it is showing relative strength versus the market? Are you just trying to watch the moving averages mentally, or yeah, how do you kind of handle that situation?
Well, so sometimes I handle it well and sometimes not so well.
Yeah.
I can tell you, like, if we went back and looked at Zoom, when Zoom was showing relative strength, like, I can remember definitively. I wish I had the chart here, but Zoom kind of was finding Zoom. I was in, and it shook the moving averages, and it was really volatile, and I got shaken out, and then it was finding support on the 50-day moving average,
Yeah.
and I was actually like trying to buy it in there, and it worked. I was trying to buy it in there because it was showing so much strength, and I gotta say, I was like so perfectly positioned right off the 50-day. But one of the days it like I can't remember exactly, but it like gapped down, and either way, I ended up like basically taking about a scratch, and then it moved, and I ended up buying it higher. Um, but you're trying to let the moving average be your guide, and it's almost like I said last time, like our job is to pick spots and see what happens. Like if you can be in the money, you want it, and it's shown relative strength. That's the key, obviously. Like
Yeah.
like if it's not shown relative strength, you don't want to try to let it work. But if you can be in the money, and you're in your spots holding, and it's volatile, and it's showing strength, like you want to try to stick with it. Like it's not always going to work, obviously, but that's what I try to do. I mean, your goal is to catch a real move in a stock, not take like a 3 to 5% gain or so. But you also don't want to take a loss if you don't have to. So sometimes in action like this, depending on where you got it, maybe you get stopped out and then you end up rebuying it here. Sometimes you're able to stick with it. You're not always going to make the right decision, um, because you can only make the right decision in hindsight.
Right.
At the time, you know, look, like people say, don't hope and pray. I say get a good price, protect your cost basis, and hope it works. Under the caveat that you're going to be protecting your cost basis. So sometimes you get to survive, and sometimes you don't. There's not a perfect answer for that. I think that's just the nature of the beast.
Perfect. And let's see, there's some questions here. First, Peloton, with that bearish engulfing you called out in June/July, do you let the fact that it's holding the moving averages keep you in rather than considering it a character change?
Yeah, so to me, this would be chink in the armor number one.
Yeah.
Because really the 20-day was the moving average of relevance.
Mm-hmm.
I don't see how anybody would have seen this coming.
Right.
And because it was really chink number one. Now this bar right here would have been more of a concern to me. Well, like this would be concerning, obviously, but it's like chink number one, right? Whereas this, you're thinking like wedge drop, I would have been, but you're able to kind of hold it the next day. Um, this is just kind of basing. Like a lot of these stocks were like this, where they were volatile. I mean, you'll see this a lot with growth stocks, but on kind of chink in the armor number one, really, I think it's when you get chink in the armor number like three is where you want to be more concerned and ready to kind of hit out. Um, So that's not the best answer, but I don't know how anybody could have anticipated this. And I think the fact that it had showed you're holding the 20 days is the reason why you don't act there. Like the stock had said the 20 days what matters, and you just have to trust that.
Perfect. Um, let's see. Yeah, I think we can move on. Yeah, I think we can move on to the next example.
So just to kind of elaborate on that a little, sorry, is
Sure.
like right here I can tell you I was shaking out, and the reason being is because we had chink one. To me, this was like chink two, this kind of like failed breakout. To me, right here as well, and then when we followed through on that, I was thinking this thing could come in. Whereas here, it's like you're probably like, oh man, I hope this thing holds the 20 day again, because there was really no reason to me. I mean, I guess maybe you could say this kind of candle here, maybe, but to me, this is really kind of the first chink in the armor. Whereas up here, I think you had more of them. Um, so that's a bad day where nothing wrong has really occurred yet.
Perfect.
All right. So Fastly, this was a great stock until it wasn't. Um, but let's look at really the meat of the move of this stock. So this was another stage one IPO base. If you go open this up and look at the weekly, you can better see it. But basically, we broke out. This is a viable gap up. This is the earnings day. So it breaks out. You can buy the breakout day with the stop at the day's low, or the next day you can buy the push through here with the stop at this day's low. Both would have worked. Kind of once it gets going here, I think you kind of adjust your stop up to this rough area. It gets going. This is kind of your first sign of distribution. A little bit after the breakout, I wouldn't be too concerned with it because it's so early after the breakout, and we're really holding the 5 day moving average. Like we haven't even, like it's so early, nothing's been defined. So your stop, you're keeping down in this area. You're protecting your cost basis. We go up. This is kind of chink number two, and that you get that bearish um, piercing pattern, or almost engulfing. Um, but we're still above the moving averages. Nothing's been defined. We're in a stage one situation, so we want to try to let this thing work. Now, this nearly does test what would have been your stop. Um, I can tell you that I was able to hold through this because I just was. Like, I had conviction in it, and it hadn't picked a moving average. It hadn't defined anything yet. And this is really the first kind of reconfirmation point where we pull back, we reconfirm higher, but this was a secondary buy area. So this was a bull flag. You could have added your position or taken an initial position. And it's the second buy area. It's buy point B. So I think it's a valid buy area for sure. So you could buy it. If you bought here, I think your stop is probably this area. And when you follow through, you want to try to get it to here. If you're long from down here, you still just want to keep your stop here. And then kind of as it follows through, you adjust it up to here when we reconfirm. We go up, and to me, this is more type of concerning action. You get that. I wouldn't even really call this a shooting star. I'd more call it a doji, a spinning top, another spinning top. But we support it here, and our stop area isn't pushed at all. And then when we push out of this area, we reconfirm. I do think this is a valid buy area because of how long the basing period is. So for all buy areas, your stops would be moved up to here. If you bought this breakout, your stop would be this day's low. And then when we follow through on everything, I think at this point, when you get up here, you want to have your stop around this area for all positions. And then when we follow through here, this is an ignite bar. You want to get your stop up here. We continue higher. To me, in the moment when you're seeing this type of action, I'm sort of expecting a couple days of consolidation. But as what we get is an ignite bar. Um, the volume is big at the time for sure. Um, and it continues higher. Now, this shooting star to me is a relevant shooting star. Someone asked earlier, would you be concerned? And in this situation, absolutely, because we've come multiple weeks and it's on big volume. And I think that's why you kind of get this shakeout here. Um, Now, I can tell you, I didn't get shaken out here, but I can totally see why this occurred because you have a big volume shooting star after a major advance. Um, but to me, it's kind of like, yeah, it's stage one. This is sort of like your stage two base. And you're still sort of early in a way. And I mean, you're not early because you're just not. But you come down, you set this, and to me, you reconfirm again, and then you raise your stops to here. Um, you come up. To me, this is your first real extension. I guess you could view it as your second extension actually, because this is the first, this is the second. So I think this was the first real like major sell into strength area up in here. Um, we pull back on volume. To me, even though we didn't hit the 10-day, if we had followed through here, I would have got out of the position. Um, but we base out. This is a buy area, but this is definitely a swing area for sure because you've got major distribution here, you've got distribution here, so you've kind of got like two pretty significant, um, things to take note of. I think the reason, because I went back and I looked at my trade, because when I was going over this, I noticed this, and that's kind of why I bring it up. And I was viewing this as like the first red flag, which is why I was able to hold through it. This was the second red flag. Um, Unfortunately, in hindsight, and I'm noticing this more and more, you kind of get these three ignite-ish type bars in a row. Um, and I'm going to start selling into this type of action later in the cycle, more from now on, because I think you get your first, your second extension, you're extended on the weekly. But, even if you didn't do that, which I didn't, the way that I played this is these were ignite bars, and you raise your stop to this bar's low, and then this bar's low, and then you kind of have this defined trend. And this is when I was taken out of it when my ignite bar lows stopped, got triggered. Um, so I do think that this was a situation where I gave a lot back, not selling into strength, but at the same time, I feel like I would have sold down here or here, with that kind of thought process of keeping things too tight. So, this is really where the trade kind of ends down in this area. I think if you go back and look at this stock, in reality, we sort of held the 10-day here in a way, but it was so early you had no idea. We held it again here, which kind of same deal. This is kind of the second test. And then we start riding up. You hold it again here. And I think at worst, you would have sold, even if you sold down here on this bar, you would have sold this 10-day break. But I do think you could exit it higher just by strictly being stopped out of your ignite bar stop. So that's how I played, or how you could have played Fastly.
And after that shooting star midway through the uptrend, what would have caused you to sell after that occurrence if we didn't have that nice upside reversal, outside reversal to the upside?
Yeah, so one at worst, your stop. Sometimes like when I get my stops in, I try like not to like pay too close attention almost.
Mm-hmm.
Like once I'm like in the money and my risk is defined. So like your stop is this area, and then at this point, you're just kind of watching, and then your stop gets brought up to here in this reversal.
Right.
If we had tanked back down, like you would have given back a good chunk of your gains. It would have sucked. Um, but really we had this reversal because the stock was so strong. It was just a little stretch from the 10 EMA. But yeah, I would have been stopped down here, and it happens. Like it's happened to me where that's almost like the sell some, hold some. That's probably why some people took some off here. Is this is an example where your open gains give you exposure, and it makes sense to take some off. Um, I would have to go back and see how quickly this happened on the intra chart to see just kind of how realistic that was, at least
Right.
like for me and knowing how I trade. I would not have been really looking to take it off there because I hadn't really seen any signs of distribution. So just knowing how I think, you know, I would have been waiting just like I did on the crowd trade where it pulled back and you got to raise stops. That would be my thought process here. And then when we reconfirm, you bring it up, and that's how I treated it.
Perfect. And for this one, did you pyramid into your position at all on those earlier buy points, or did you just kind of establish a core and just keep it all the way through?
Yeah, I did. So on this one, I'll tell you, I took a pretty huge position here because my little brother works my little brother works for, I don't even know if I can say the company or something. Yeah, he worked for Oracle at the time, and he basically sold in this space, and he had basically told me this company has the best product by far,
Mm-hmm.
I definitely don't trust his opinion on stocks, but I trust when he tells me something about an industry he's in. So I actually I tried this stock, I think down in here somewhere. I can't remember exactly where. And then my buddy Joe, I don't know if Joe's probably on here. My buddy Joe, he's probably one of my best trading buddies. He was really onto this story, like big time, like in advance, and we had been like waiting for this thing. Kind of like some people have been playing some of these stage one IPOs like Affirm and stuff. Like at the time, like we were really fired up about this thing, so we were ready to go on day one, and I sized this pretty good. And then I bought more here and I bought more here. I think I had taken some of this off into here, like a small amount, because at the time, like this doesn't look extended here, but it did at the time.
Right.
But then in here, we went after this thing pretty good. Like this was one of my really big winning stocks last year because of the size I had in the stock. So yeah, definitely pyramided this, and that's like a good thing to note is your big winners are like, think about it. You had 1, 2, 3 good buy areas in this stock. Whereas some stocks give you like one buy area and they go, and you're not going to make as much money in those stocks because you're just not going to get the chance to get really, really, really big in the stock. So it's almost better when a stock doesn't just rip. And it gives you some different buy areas kind of near the top, call it 1/3 of the run, because then you can really, really, hit it hard.
Great.
All right, so Livongo, I would say Livongo and Fastly, like first part of the year last year, were definitely.
Actually, Oliver, can I ask? There's actually
Yeah.
one more question. That third Ignite bar in July, do you consider the psychological number like the 100 level? Because it looks like it tried to take it and failed right there.
Yeah, exactly. I think this is a good area to sell. I can just look. I'll tell you, I got excited with this stock. I mean, I did. I just did for sure. But yeah, I think the whole number. You read Livermore, we failed the whole number, and that was probably an area to get off the stock. Unfortunately, I got off it, down in this area more. But that's another great thing to call out.
Yeah. You let price action dictate at the end of the day.
Yeah. But yeah, I mean, basically, is you had like the 10-day, the rising trend line, your Ignite bar stop. You had a couple different things. So if you handled it perfectly, you sold into this. But if you didn't do as well, there's a reason why this bar was so big, because
Right.
a lot of people were probably doing exactly what I did.
Exactly.
I was just part of the herd, you know.
Right.
um, all right, so Lavongo. This was like another name that was just awesome. And really, I went over on the buy side. I used this as a relative strength example, so I'm not going to go too deep on that. But basically, this was up an EMA crossback, a bull flag. This is kind of the breakout. Your stop would have been below the moving averages. This was like a secondary area where we reconfirm and you bring your stop up to here. I think because you're just taking out this IPO high, this is still like some people probably this was their initial buy, right? And so it goes up and it pulls back. And this is a very good buy area. I think I told you guys before, one of the biggest mistakes I made that I didn't make in Facet, but I made in Livongo, is I had a pretty outsized position on this, and I'd taken a little bit off into this rally, into this 40 area, and I didn't take this buy area here to add more to my position, which was a really, really big mistake. Even at the time, I knew this was a good buy area, but I think I didn't want to mess up my price or something. Trust me, this haunts me a little bit because this was a really good buy area. But basically, this is the next buy area. If you take this, your stop initially is below the 20 day, and then when it follows through, you move it to the day's low. And same with your buy areas down here. When they come up, and you reconfirm your stop areas going to here, and then as the moving averages kind of get above your buy area, they become more relevant, and that's exactly what happens here. So you move your stop to here. If you had added to your position, position A, your stop would still be down here. Position B, your stop would be the day's low, and then as it works up, you bring both positions up to here. So we go up. This is an example again. I want to emphasize this because I used to really make this mistake a lot. I would sell like right here, and I'd be kind of buying it back higher. This is day 3 of the breakout, and you get that shooting star. This is all about that whole concept of context, and then it's not that significant. It's not a significant shooting star. So we pull back. We work higher. I can tell you, I got shaken out of Livongo right here, and I bought it back. And the nice thing that I did do here is I didn't add to my position here, but I did take a significantly larger position here based on that William O'Neill concept of once you get shaken out, you have to buy more back. So we go up. I do think that this was a buy area right here that ended up failing. I didn't take this because I had just been in this, but if I hadn't been in the stock, this was a buy area. We break out, stop days low, and it fails. This would be a situation that just stinks. Like it supports at the 20 day, and it ends up going higher. And that's just like part of the game. That stuff happens, and it's gonna happen a million more times if you trade long enough. But if you had this area down here, you held through. We hold the 20 day. I think this is another buy area right here. I'll never forget this because I think Goldman Sachs said like sell the stock, and then they probably bought a ton of it. And we break out. If you're in from one of these areas, down here, your stop is below the 20 day. Like I think at this point it's pretty well defined. The 20 days, the moving average of note through here. So we go up. This is another example where we just break out and you get like a shooting star. This is on like day 2, and it's just not relevant, which is why you get that support. So we start to get extended here, and we pull back. And notice now how we're holding the 10 day. So to me, this is like a slight change in character. It doesn't mean much. I can tell you that if we had lost this area, I probably would have sold this stock. But it's what we do is we break out. I think this is a valid buy area, and we really start to get moving now. So if you bought this buy area, your stop's the day's low. as we follow through, you're raising it, and on every position you have now, your stop is now raised to the ignite bar low here, because you also have this big gap, which big gap ups equals strength. When you take this out and then also follow through, all positions are here. Um, this is the first extension, the first sign of distribution, which it's supported. When it gets supported and you reconfirm, you're raising stops to this area. And when we break out here, this to me is definitely not a valid buy area because you're also overcoming this distribution, which I always think you want to be careful, like taking new positions around distribution. But you raise your stop to this area, and sure enough, that's exactly where we support. But we're starting to see tiredness build up here. This is kind of chink in the armor number 2. Um, and then I guess this is a breakout again here. Again, I just think you're playing with fire, buying these types of breakouts. Um, we've started to see the stock go from respecting the 20-day to the 10-day, and now it's really accelerating. And then is what happens is we gap up here on the Teladoc news. Um, and I got to give a shout out here to Puru Saxena. He literally tweeted out in the morning that he thought Livongo selling their business was a huge mistake. And I got out of half my position in the pre-market. And unfortunately, I think I sold the rest. I can't remember exactly where, but like kind of down here. Same deal as Passy. I'd done so well in it that I didn't fade myself as hard as I should have. But I think I could have got out of the whole thing definitely 140ish. I think I got out of the rest like literally like the low 130s. So I gave back, you know, that was a big bar. I gave back a chunk. But huge trade, awesome trade. Notice how we top on good news. Um, I think I'd highlight again that like there's volatility in these growth stocks. And if you're not willing to trust your stops, like these stops literally worked this whole way up, but it definitely wasn't pretty. So you gotta kind of be vulnerable enough to trust your stops and just, you know, hope that they work almost because they do work. And there's a reason why this low is like above this low. You know what I mean? There's a reason for that. And then notice the acceleration into the top. Topping on good news, I think, is something you're going to see very regularly. And that's, that was an aggressive sell signal. But if you didn't take that, I think your sell signal would have been down here when we lost the 10-day, because that's kind of what we had started to show respect for. So at worst, I think you get out down here. And at best, I think you get out selling into strength. And then let's say that you had still been using the 20-day, which I think was okay. Maybe you got shaken out here. But if you held, definitely this wedge drop here is what's going to, protect you and really keep you out. So notice how that there were ways to play the stock, but then the cycle ultimately protected you because you don't actually get your wedge drop until right here. But it protects you from going through what occurred next, which was this ended up being the top of the stock. So if you bought this breakout, it didn't exit till the wedge drop. You were protected by the cycle.
Yeah, I remember going into that morning. I had Teladoc and Livongo, and that was an interesting morning for sure.
Yeah.
Yeah, and also it looks like we're about, I don't know, 50-60% above the 50-day moving average. It might have been a weekly extension too on that time frame.
Yeah, it would have been. I didn't have those stats or anything like that
Yeah.
looking at now, but now that's something that I'm gonna more incorporate. I'm gonna more even though I use the 10-20 day, I'm gonna be paying attention more to how extended my stocks get from the 50 and 200, and I'm gonna kind of cross reference that chart. So like I'm not gonna like to me this would have been in that small cap column.
Yeah.
So I'd probably be looking at that those set of numbers. But I'm gonna be paying more attention to that, especially more once I kind of study names and verify that I think those numbers are legit. Which, based on what I've done so far, I think they are.
And we've got, yeah, so Sunil's pointing out that we're kind of, this is also an example of where we kind of respect that 5 day moving average with that accelerated advance versus the
Yeah,
20 day.
absolutely. So I think that if somebody had even wanted to sell into this, like when I go back and look at this, actually, like I think now with my experience, like I'd probably be selling into this or this because
Mm.
I do think that this was pretty extreme, and I think generally in most markets, uh, I think that these areas, like really, if you think about it for a second, this is like the third extension,
Right.
and a lot of the times you're not going to get that. Like this, if you go study this, like this was a true blow off top. Like try to convince me that somebody didn't know this merger was going to happen. Yeah, right. Like people knew, people knew,
Yeah.
in my opinion, but they got faded. And I think that's often gonna happen where big growth stocks after an extended move top on good news.
And people had some questions about the shakeout rebuy. So could you talk through, oh, first of all, kind of what O'Neill says about that, and also how you manage the stop loss on that position and position sizing and all of that?
Yeah, so O'Neill's rule, I don't know the exact rule, but he uses the 50-day. And it's basically just, it is what it is. Like you have a good position you really like, it's got big earnings, you've got big sales. And also I would imagine that O'Neill is not like buying a shakeout later in the move,
Yeah.
so I would say that as well. But it is what it is. You get shaken out, so you get stopped because you got to be disciplined. Like you don't know if this is gonna fail and go all the way down to here. You have no idea. So you get stopped because you know that's if you're following your rules. But then you show a little humility and say like, "Wow, like I got shaken out and I was like wrong," but the buyers showed me I was wrong, and so
Right.
you buy it back through the high of the day here, or if you're aggressive, maybe you buy some back that day. I really can't remember what I did actually if I bought it back this day or through the high of the day, but I know that I bought back more than what I sold. Part of the reason I did that, bought more, is because I realized I had made a mistake not buying here, and I kind of viewed this shakeout as an opportunity to get back on like real size. So it is what it is. Like when you see a shakeout, if you think about the psychology, you know, weak hands like myself sold and strong hands bought our shares. And, we want to be following the strong hands, the institutions, the guys moving around real cash. And that's really what a shakeout is it's a transfer of ownership from weak momentum players, whatever you want to call me, to Fidelity, to T. Rowe Price, who are stepping in Columbia, whatever,
Yeah.
any institution, and they're supporting the stock and saying, no, we like this stock because they're the ones who are holding for this move.
Right.
They're the ones that are creating this move. And so that's the logic behind buying more shares on a shakeout. Is it's just the idea that it was a shakeout, therefore the stock should go higher. And it's also a sign that institutions are showing support for the name.
Perfect. And there's also a question here from Mark. On an extension, if you're selling into it, what portion of your of your total position size are you selling into strength?
Sure. So, if you're going to take some off in the first extension, that's kind of like when I talked about sell some, hold some, or whatever earlier. That's kind of number two, where you're probably taking off like a quarter to a third of your position. Whereas the second extension, I actually think, based on just looking through tons of names, I think it's reasonable to take your position off into the second extension. But you could also take the approach of taking off another quarter or third, so that you've got, maybe like a third of your position left to sell into weakness. So it just depends how aggressive you want to be selling into strength. Um, I think a sort of, I don't know if this is the way to put it, but a less stressful way to trade is you can take it off into strength and just be at peace with the fact that you might not always sell the top. Um, but so let's say you do like a third, and a third into weakness. I think that's it. That's a good approach to take with selling into strength. So let's say that you sold a third of this on this first extension. I personally only think that this looks like the first extension in hindsight.
Yeah.
I certainly didn't see this coming. Whereas, this to me, I think is when you see this false breakout here, I think even if you didn't get out of it until the close or whatever, I think this is a little more reasonable to take some off into. And, this is definitely an extension that's more obvious.
Right.
And this is the second or third extension, depending on how you interpret it. And I think this is a fairly obvious extension. And that's why I say, like, you want to be more aggressive selling that second extension. And I think that second extension is going to be more obvious in that you have the acceleration, you're further in the trend. Like, anyone who doesn't kind of sense this euphoria in a way, you're probably like a little bit married to your position, because I think this is pretty obvious, whereas this isn't. But yeah, generally about a third or a quarter, just kind of depending on how you choose to play it.
Great.
Yeah. All right. So Zoom, I wanted to look at, like, this is definitely not a buy from a base. Like, this is a little bit more later stage, right? So this was a later stage swing trade that ended up developing into a rising wedge into the top on Zoom. So it gapped up on huge earnings. So this was a big bull snort, and then it pulled back inside bar, which to me, it's going to go either way, right? It's going to break down through the lows here, or it's going to break up through the highs here, and it's pulling back and it's respecting the 10-day. So it takes this out, and that's your buy area. Your buy area is really, pull back to the 10-day, breaking out of a bull flag. It goes up, it pulls back, and then right here, it to me, right here is where it reconfirms, and you're raising your stop to this area. So your risk is managed at this point. And then I can just tell you right here, I was like really hoping it was going to push out so I could get my stop up to this area. And it kind of stalled here a little, but nothing bad happened. And this is kind of one of those situations where at the time you're pissed, but at the end you're good with it, where it gapped down. Stop was right here. I could have easily been stopped out if it failed through the 10-day, but they supported it. And now, even before it follows through, I'm definitely raising my stop to here. And then when we get follow through, which this could be viewed as another buy add area, when you get follow through here, now you're raising your stop to this day's low. This is an ignite bar. You're raising your stop to this low. And this actually, when I was reviewing Zoom again, this reminds me a lot, almost this kind of extension here of like the recent UPST trade. This happened to make a third extension, but it just kind of reminded me of it when I was going through this. But so your stop is at this ignite bar low at this point. We pull back. We come up. I'm waiting for reconfirmation at this point so I can get my stop up to here. It doesn't quite happen. We start to show respect for the 10-day again, though, which is why we bought in the first place. It respected here. It respects here. So I'm actually right here when we trade up. I'm raising my stop to below the 10-day here, because that's what it's respecting. We put in a bunch of tight candles here. I sort of view this as like a chink in the armor. This is a chink in the armor. This is a chink in the armor. So we got three of those, and we're continuing to hold the 10-day. I'm also noticing here that we've got a developed trend line at this point. So at this point, one touch, two touch, three touch. This is an inside bar, which could be a swing entry long, ignite bar, stop up to this day's low. And so you've got the 10-day defined, you've got the trend line defined. This to me is the third extension. I can tell you that I did take this off when we lost this spinning top low. Um, the other area would be a loss of this trend line in the 10-day right here, and then your absolute stop loss if you missed both of these areas would be the wedge drop right here. And a couple things to note here is we've got kind of just first little shooting star, nothing crazy, no follow through here, kind of chink two. Number three here, no follow through here, just kind of like the chink in the armor, number four. And then here, if someone talked about resistance lines earlier. I had this drawn, which is partially why I was able to exit on this, spinning top, or I guess you could maybe call this a shooting star. It's sort of like a spinning top to me. But it's because it failed at this resistance line. You had the wedge, and if you look at the weekly, I didn't pick up on this extension at the time, but by this point on the weekly, it was clear we were pretty extended. And in hindsight, totally in hindsight, I might actually have with what I know now, I might have shorted this wedge drop moving forward, just because of all the things that I talk about here. But that's kind of how you could have played Zoom, and that's how I did play it. But this is more of a later stage buy versus like out of the base breakout, and how using the rules, reconfirmation, utilizing the 10-day. I would say I'm like a later stage area. You don't have the luxury of waiting for like a 4 to 6, 8 week move or so, like when you have the stage one base breakout to see which moving average it's going to use. Fortunately, this lets you know pretty early that it was going to respect the 10-day. And it was almost like amazing how this held the 10-day through here. I remember sitting through this every day, getting pretty frustrated. I can tell you I was about to time stop myself on this, because I was thinking right here it was definitely going to lose this. And it just kind of like held the 10-day like every day. And when you see that, when you lose it, remember everybody else sees it too. So if we had lost this here, you would have wanted to be a seller. But then even here, it doesn't follow through. The evidence is piling up, especially if you're seeing the big picture, the weekly, that this was probably. Look, if this hadn't lost this low and it had based and kept going, I would have stayed with it. But I would have started to keep moving my stops up, because sometimes, and I think because of where this was on the weekly, it would have led to a blow off top. But sometimes you can get these resistance lines and it'll base and it'll blow through, and that's almost like a buy area, which often leads to like a blow off. But that's not what happened here. I'm just saying it because maybe that's something to watch out for.
Great. I'm not seeing any questions on Zoom, so I think we can keep on going with the examples.
All right, so net. So this was a trade that it really, there was a buy area at, I believe it was 46 that I had, and it exploded on volume. I remember tweeting out like, hold this thing, it's got big volume, and then I ended up like selling it through here when it had this, and then when it went up, it didn't follow through higher. I got out of it. And I remember being real frustrated because I was real excited about this thing. I thought with the volume it had on this move, feel free to go back and study this, that it was just going to explode higher. But it just wasn't quite ready. And it's what it did is it came down in here and it tested the 20-day. It had an inside bar here. It had an inside bar here. In hindsight, I got pretty lucky. I bought it on this day, but really the breakout day was here. So let's analyze it from here because we're not always going to buy it here. But this was the breakout day, and to me, this is a tough situation. You probably keep your stop down in this area, but once it follows through, you get your stop to this day's low. And then it explodes higher. To me, if this had finished up here more, I would have put my stop at this ignite bar low, but it didn't. So gave this thing room to test the moving averages, and that's what it did. It tested this moving average. It came back. It tested here again with a bullish counterattack bar. So right here, when it follows through here, moving your stop up to here, because this is kind of, I guess technically it's not a reconfirmation, but it sort of is. We don't take out this high, but we take out this price area. So move my stop up here mainly because if it had rolled back over here, like I don't want to lose money on this position. But then when you get the bullish counterattack, you raise your stop to this area, and we kind of tighten. I think this is another buy area. I gotta say I can't remember whether I took this or not. I think I probably didn't because I already was in it. But if you weren't in it, this is kind of a choppy area where this probably looked like a buy area. Your stop would have been down here. And if it had gone out, you would have raised your stop to here, but it didn't. So you keep it below the little shelf and it chops, it keeps you in. Same deal. If I was treating this as a fresh buy area, I would have been pretty frustrated on this day. And I would have kept moving my stop up to this day's low. And then when it followed through, that's when you move your stop up to this day's low. And actually from this position down here, you also move your stop up to this day's low because it really pushes out and it reconfirms. Maybe you keep it below here, below the 10-day for this buy area, but for the second buy area, if you got it in here, you would be finally raising it to here, and you would probably feel pretty good because here you have risk down to here, right, all through here, and now when it goes, it's like you get to take your risk off the position kind of. So it goes up. This to me is kind of, I wouldn't necessarily call this a red flag. I would just say it got a little ahead of itself. You could almost say it's like buying interest. I'm sure there was news or something here. I can't remember. But this to me would kind of be your first, quote unquote, red flag, if you will. But we pull back, and what do? We hold the 10-day. So 1, 2, 3, 4, 5 times we've shown respect for the 10-day. That's your moving average of relevance. And then we're also starting to see 1, 2, 3, 4 touches. Once it kind of pushes off here, hey, we've got a relevant trend line here too. So we reconfirm price strength confirmation. I'm just going to talk as if the buy area here, because I explained where you move it. So we raise our stop here, we move up, we pull back, we start to push up. I'm raising my stop to here again. Probably when you take out this area, I'm even the type of guy, I'm moving it up a little bit to here. But we go up, we pull back again, and when we take out this area as high, you're raising your stop to this area, even though it doesn't quite follow through yet. It took that out, so that's your reconfirmation. Your stop's here now. We come in, we're holding the 10-day again, and we're seeing 10-day hold, 10-day hold, 10-day hold. I mean, it's pretty clear which moving average this stock is respecting. So is what happens on this stock. You get this doji here, so that's kind of red flag number 1. You then get this sell down here. This was probably a good sell area in hindsight. I can tell you that's not where I sold it. But in hindsight, study these dojis when you kind of get extended into the moves like this. I can think of another stock that I traded last year, App, where I did sell the doji, which kind of played out the same way. But it pulls back, holds the 10-day again. If it had lost this day's low, like you're definitely gone. And really, to be consistent, like I think you could have used intraday price action here to get out of this thing based on this also being a failed breakout and a couple, different red flags we've already highlighted. But I'll tell you, for me, I was really watching this trend line. I was really watching this trend line. And when we got the doji, this bar, and then this bar, when we traded up and traded back down, and then what do we see here again? Gap up that gets sold. I got out of this thing when it went green to red. And you'll notice, I think, in all the examples we've gone through today, I think probably 3 or 4 of them, you've seen that gap up after kind of 3 to 4, red flaggish type days that got sold. And that to me was the area to look, if I traded this better, done a better job, I guess, maybe you get out in here somewhere. But this to me was a pretty clear sell area. You got the trend line with like 6 or 7 touches. You've got the 10-day. You've got the, kind of multiple days to take note, and then the gap and trap, which again, get those 3 to 4 days to take note days, and you see the gap up. Don't get excited. If it doesn't follow through, which this doesn't, have your head on a swivel and be ready to hit out of that thing. That's something that I'm definitely cognizant of because I've seen it so many times. And that is, net's gone much, much higher since then, but there's been other buy areas since then too. But for this specific trade, that was the trade.
Great. And there were a couple questions with this one about how you deal with earnings, because that first buy from the downward trend line, I think that gap up was on earnings that got sold down. But just in general, how do you deal with buying shortly before earnings reports, and also how do you manage your position through earnings reports?
Sure. So it depends where the stock is in the cycle. If this was earnings, my guess is that I even though I got stopped out here, I made pretty good money here, even though I got stopped out, and I was in the money. So I'm almost to the point where I'm not even sure I'm really going to look at earnings, depending on where the stock is in the cycle, because I find oftentimes it does what it's supposed to do. Look, we could go look at Fastly, and I'll tell you, I got caught both in those gap downs. But in hindsight, the reason I got caught in those is because I was playing a stock that had already played out. Like, it had already made its move, whereas net was really, it broke out. I think I'd have to go look at the weekly, but it really kind of broke out at that 46 area, and this thing was kind of just getting going. And so I'm more looking at kind of the cycle and how the stock is and where it is in its cycle. And I'm trusting my rules on that. So I will hold into earnings. I know a lot of people won't. I will say, if a stock now, kind of after getting hammered in Fastly last year, when a stock's extended into earnings, I will take some off the table or exit the position. And my thought process on that is that if it's already extended into earnings, the earnings could be really good and the stock might not go anywhere just because it's already moved a good bit. And I can show you a couple examples of that. AMD recently, on its most recent report, it was extended and I got out of the stock, and I think I bought it back on the bull flag, like literally maybe a couple points lower. So kind of my rules on earnings are, I either need to, one, be partialed out into earnings, and that's usually going to occur, let's say, just because we have this on the screen, let's say net was going to report earnings like right here, and I bought some down here and it's already moved, like 60%. I'm going to be partialed out going into earnings there, because if they miss, there's a lot of room for it to fall, right? But if they report well, it may not really go anywhere because it's already moved a long ways. So it's maybe like, if they report well, it's like, okay, all of this, people expected it to report well, and it just kind of chops. Um, or secondarily, I have to be willing to add to the stock after earnings. So I need to be partialed out into earnings. Usually, if it's moved away, it's going to be partialed out. Or secondly, I need to be willing to add to the position after earnings. And that is a situation where I believe we're earlier in the move, and good earnings could ignite it to move higher. And therefore, I want to be willing to add on that good earnings report, if that makes sense.
Yeah, for sure. I think those are the main questions I saw associated with this chart. So I think we can move on to the next example.
Okay. All right. So NVIDIA, this is, yeah, there it is. The date's on the bottom of the chart. This is May this year. We had been in a correction. I've already gone over this descending channel and everything on the buy one, so I'm just gonna go over the management. But we had the wedge pop, the descending channel buy area. So if you buy here, your stop is the day's low once it kind of follows through. And then when we gap up, like literally day two, your stop is really being moved up. And the nice thing is here, you're kind of protected by the smoothing average cross a little bit, right? And so we go up and we consolidate. And here's an example where we were a little bit extended, but we're still kind of early in the move in reality. Like we haven't even broken out to new highs. And they reported earnings, and this right here is the day after earnings. It was one of the weirder reactions in that we basically didn't do anything. Like we didn't go higher, we didn't really go lower. It was kind of weird. But then this bull flag, I actually added to my position in this, and that was kind of what I was thinking, is that if I was going to hold into earnings here, I had to be willing to add. I felt like if they missed, like I had a lot of protection down here. Now, naturally, like could it have gapped down and lost the 200 day and really blown up? Yeah, it could have. There's a risk in holding into earnings. But based on the buy area, I felt like I had protection from a lot of these moving averages and it being early in its cycle. I thought it was worth holding in, and sure enough, it was. It went up. I can tell you, I think I showed you guys before. I had a rising resistance line drawn on this thing, and exited this, but then bought it back. I think that was a mistake because of how early we were in this move. But if we're just working the rules, when we took this out, we reconfirmed this buyer. You raise your stops here. To me, this is an ignite bar. You raise your stops here. I guess this is an ignite bar too, and it works. I might not have raised my stop here because I wouldn't have got it shaken out. You didn't get shaken out either way, so it worked. So I don't know why I even bring that up, but just try to give you insight to my thought process. This would be, to me, a later stage buy area right here, but still valid if you're going to take it as like a swing type trade. But for lower buy areas, buy area A, B. So I think like you want to be saying buy area A, B, and anything after A, B, I think are more swing type entries. So A, B, we reconfirm raise stop to here. We reconfirm again, raise your stop to here. This is the first extension. I can't remember what stock we were talking about earlier. Where I'll show you in the video like a big shakeout bar that got supported. That was this on the video. It supported. You raise your stop to this day's low right here. So basically, stop raise here, stop raise here, stop raise here. Ignite bar, stop raise to this day's low because it's a breakout too. Pull back, stop raise to here. And really when we reconfirm in this instance, since my stop's already here and it's such a wide area, I'm probably raising my stop to like this area. And then when we really push out, I'm raising it to this area. And then you follow through more, I'm raising it to this breakout day low. I think even this is a little too late to even treat as a swing entry. It worked, but only in hindsight. Like this could have just been like a little bar up. So this would be too late. I think maybe this would have been your last swing entry. Um, but your stop trace to here, and we go up. This is an example of that doji that I talked about earlier. I talked about with apps, and then I showed it on net. But we get the doji, and you gap up, and it sells down. I will say I did a pretty good job here. In hindsight, obviously, but I was able to exit this here. But I almost think I got lucky, just to be honest, because we pull back, and really the way that this sets up is we sort of hold the 10-day here. It doesn't touch it, but it's that first pullback, second, third. This is really where we show the 10-day, really second test of the 10-day. The way is what I was thinking on this, and why I got out of it is we kind of held the 10-day this whole way. And then I felt like on this pullback, we were starting to hold the 5-day. And when I saw the doji and the gap up, I was thinking that this was kind of that acceleration into the top. So that was my thought process. But in reality, if you didn't exit that, we held the 10-day again. We go up, we hold the 10-day here, and then I think this was the trend line break. And this wasn't as defined of a trend line. I mean, you had touch point 1, 2, 3. Yeah, I guess it was 3, 4. So this would be your exit if you were going to continue to use the 10-day and the trend line stop out. So two sort of thought processes. One was we were holding the 10-day, felt like we were starting to hold the 5-day and accelerate into the top, saw the doji, saw the gap up. So that was my exit. That was more the kind of aggressive sell into strength type of exit. And this was the more, 10-day EMA trend line exit right here. And then at that point, the trade is over.
Yeah, and Jay points out $200 failure as well here.
Yeah, $200 failure. Again, another good point. That's probably something that I need to look for more. Thanks for pointing that out.
Perfect. Yeah, I don't see any specific questions. I think we'll do NVIDIA part 2, and then maybe take another break and then finish strong. How's that sound, Oliver?
Yeah, that's perfect. So let's look at NVIDIA. This is fresh, and I'm sure a lot of you guys were probably in this trade. So NVIDIA breaks out around 208, 213. I went over this on the buy episode. So we break out, and to me, when we kind of follow through here, your stop is this day's low. You could almost view this as kind of reconfirmation, but I don't feel like there's enough of a shelf here. But I think right here you could view it as reconfirmation and raise your stop to down around this area. And then when we break out here, this is technically an ignite bar, and you could raise your stop to here because it's just breaking out on the weekly here. I'd probably want to have my stop down in this area just in case, to give it some wiggle room. But then we get this wick play setup, and it's kind of your B entry, and it breaks out of here. If you're on the A entry, I think at this point you are raising your stop to here, and then kind of when it follows through, you're raising it to here and here. But if this is your entry, your stop's here, and then kind of when it follows through, you're raising it to here. And then right here, when we push higher, I think for all positions, you're raising it to this area, even your A entry, like right in here. But then, you've definitely managed your risk at this point. And so I personally was sorted in sell into strength mode here, because I was just kind of looking at the weeklies and thinking we were getting really, 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 really extended, like big picture. So I exited into this extension, because I was thinking extension sell rules, which in hindsight was a mistake, because I did end up trading this a couple more times here, and it just it was harder to get back involved. And that's kind of that idea that, sometimes you're going to sell an extension when you should be using trend rules like the 1020 EMA. Um, and sometimes you're going to use 1020 EMA rules and you should be using extension rules. But that's the art of how you sell, which you're not always going to be right. But so to me, this was kind of that empty wick. And then this was sort of the lack of follow through, but it also didn't fall apart either. So this was kind of like, red flagish number one. This gap and fade was red flag number two. But overall, this whole section here is the first extension. Um, we pull back, and now the stock shows us what moving average it cares about. To me, this is kind of like a 10-day hold here. So here, here, here. And I think part of the reason I sold this extension is because I knew earnings were coming. And I was a little concerned with kind of how stretched we were on the weekly of holding this into earnings. I just kind of been able to sell the AMD before earnings and get it back. Um, so maybe that played in my process. I don't know exactly 100% what my psychology was. Um, but, I'm just trying to talk freely. But basically, we gap up on earnings. But to me, this is the second extension on NVIDIA. First extension, second extension. I think most people would agree. Like overall, you're getting a lack in momentum here, but you're still holding the 10-day. And I snipped this chart before this played out, but you'd have a trend line drawn all the way up through here, which we eventually ended up losing. So if you were using your 10-day, then also you get the trend line rules. We end up losing the 10-day and the trend line on the same day, which I can't remember if it was Thursday or Friday of last week or whatnot. But it was one of those days, and I think I showed a chart of it in here earlier that showed we lost the trend line in the 10-day, and that was your sell area. So if you think about it, buy ad, stop here, reconfirmation, stop here, buy ad B, stop here, or A position, stop here, reconfirmation, raise your stops, ignite bar, raise your stops, first extension, anywhere in here. I think if I had played this better, I would have exited, third or whatever we talked about earlier. But pullback, continue to starting to show respect for the 10-day. This trend line is starting to develop here. Second extension, if you recognized it, exit into that. But I'm sure, this is how divergences build: is you have the high, you get the high that fades. So if you drew this top here, it fades, and then if you drew a line here, it fades. That's how a divergent builds, where we're moving up, but there's no follow through. And then your exit, if you were using the 10 EMA trendline rules, would be when we lost that area, which happened a couple days ago. So now, kind of the thought process on NVIDIA is it's extended from the 10-week, and it's probably going to rebase here. The doom and gloom is that it topped here. I don't have a clue whether it did or it didn't. For me, it's just kind of, we'll see if it builds a new base. And if it does, we'll get another buyer. And if it doesn't, you're out of the stock.
Perfect. I don't see any questions coming in on NVIDIA, but there's a good one from Mark. When you are at a profit and keep your stop far away to avoid your shakeout, how much percentage are you willing to give back before moving your stop higher, or are you just looking at where it reconfirms and that's your stop level?
Yeah, I'm mostly just kind of looking at the stock because, again, for like you got to be careful with like a small cap. Like you're gonna have to give it more room, which
Right.
is naturally more risk. But you might have a smaller position in that stock because it's a more volatile stock. So whereas a stock, like for me at least, like a stock like Nvidia or Tesla, like I'll take pretty big positions in because they're bigger caps, they're liquid, and that's more what I'm kind of used to trading. Like, look, if I can hit a Livongo or a Fastly hard, like that's amazing. But for the majority of the stocks I trade, they're probably more. Well, really, I like to think I take what the market gives me, and lately,
Yeah.
like the market's been rewarding these types of stocks. Whereas, like giving back like 20% of your gains in like a Nvidia or something is a significant amount, in my opinion. Whereas in like a Livongo or a Fastly or some other names we talked about, you know, that stinks, but it's probably not totally always outside of the personality of that stock just because
Right.
of how it moves. Um, like for example, like if you're like a recent stock that like I thought was maybe gonna work, but didn't really, like that MTTR stock. Like I don't think you can trade that stock with like, hey, I can't afford to give back 5 or 6% of my gain. It's like you just can't even trade the stock correctly. So you're better off like taking a smaller position on it, or you could take a bigger position and try to take some off, and then so it allows you to kind of hold through a natural movement for that stock might be much larger than a stock like Nvidia or Tesla or even Apple. I would expect the pullbacks to be less than like a Tesla or Nvidia just because of how they move.
Yeah, I think that's an excellent answer. Um, and yeah, I think at this point, let's take a. Do you want to do a 5 or 10 minute break? Up to you.
I'm good to do a 5. I think we got a couple more to run through, so maybe let's do a 5 minute break.
Yeah, let's do a 5 minute break. Come back around 2:47 or so, and finish strong.
All right, cool. So next, I'm gonna look at Roku, and I'm gonna show you. You know, with Roku, not every trade worked great, but then there were some great trades in here, right? So this is, if you go pull up Roku and look at the weekly, sorry, excuse me, there was like a bigger weekly descending channel here, and then you have this tight channel. Really, the wedge pop was down here, and this is almost sort of like a crossback in a way. But inside bar, this was sort of, in my eyes, actually sort of an advanced buy area, if you will. Um, and we break out, and that's the buy area. Stop goes down here. Up here, I think, is an additional buy area, and then you have a cup with a handle, two inside bars. We break out. This is kind of buy area B, and your stop would be down here, moved up to here, and for stop area or entry area A, your stop is here. And then as we follow through, all stops are kind of brought up here to this area. So we go up, we pull back, and when we move higher, kind of similar to net, like I'm moving my stop up to here, and I'm continuing to let it trade, and it does. And for me, I know my personality in action like this, I'm getting really frustrated because we're not really moving anywhere, but also nothing wrong has happened to the stock. So you got to stick with it. Um, and just like this right here is technically a buy area. I can tell you if I'm already in something. This is buy area C. Probably not taking that just because it just hasn't really been moving. But when we move up, we've officially reconfirmed. And right here, you move your stop to here. Probably here, I'm actually moving my stop to here. And I can just tell you, in this bar, I'm expecting to get stopped out. I can just tell you that. Doesn't happen. Gotta get lucky. And when we move up and definitely take out this area, I'm moving my stop to here. And when we go up, you could have been stopped out here because we technically scum this area, but we do hold the 20-day. But then here we trade up and down, and the wedge drop is here. So wanted to show this one because it's a trade you're in for like a while, and it just doesn't really work. I mean, it works for like 8 to 10. I guess if you had it perfectly down here, it worked for like 12 or 13%. But I think we all agree, like, at this point, you're kind of expecting it to go up and hopefully trend the moving averages, like some of the other examples we've shown. And it just doesn't, which that's okay. Like, again, that's like part of a lot of your trades are going to be like this. But we come down and we set and we tighten in here, and we have another wedge pop here, and this is a buy add area. Initial stop loss down here. Once it kind of gets going, you adjust your stop to here. We base inside, and when we take this out, reconfirmation. I'm raising my stop to here. We continue higher and push up, raising my stop to this area right here. Shakeout here. If we had come back higher, I would have raised my stop to here. Instead, you get stopped out of the position. So it's kind of like, man, like I've been in this thing twice, and yeah, we've made money, but it just like hasn't really worked, right? It just hasn't worked, and it's frustrating. But this is often occurring when the index is just not quite ready. And it's really the stock's actually showing relative strength, but the market's not ready, right? Or maybe the market's ready for a couple of days, and that's when you're getting these bursts higher, but it's just not ready to really go. So what happens? We come down. This almost reminds me of that Zim or Zoom example that I was talking about earlier, where it was kind of like the market was falling apart and it was testing on the 50-day. Like, see how we're holding here. We get an inside bar and we have a wedge pop. We pull back, and this is sort of like that flaggish type action, and we break out. So we break out. Your stop's down here, and when we follow through, your stop is moved to this day's low. This is buy area A for me. We move up, we pull back. This is kind of like a bull flag, but it's not clean. It's not really, but I can tell you, I do remember, getting in on this. And this is kind of buy area B, either here or like right here. But either way, buy area A, when we reconfirm here, you're raising your stop to here. And taking note of the fact that it's holding the 10-day. It's still very early in the move though, so it's just something that you're cognizant of, right? And then we move up. This is like a breakout bar from buy area A. You're now, you're definitely moving your stop to here. And if you even buy area B is right here. And then as we follow through, for buy area B, I think you're moving your stop to here. For buy area A, I'm waiting for a little more follow through, just because. And when we do kind of get this follow through here, now all stops are to this ignite bar low. And then we're moving higher. This is kind of that situation where you might feel a little bit exposed, because we're not really getting a pullback and an area to reconfirm on to raise stops. So, we're a little exposed, like 10% exposed in a name like this is a decent amount of exposure. And we gap higher here. You might almost even be thinking this is an exhaustion gap, but we consolidate out, and then we finally reconfirm. And I raise my stops to this area. Now, this right here is an example of an ignite bar with very little volume. If you were to go look at this, there's not a lot of volume on this. And this is kind of an example of an ignite bar you want to be a little suspicious of. And sure enough, we trade inside one day, we gap down, we come here, and then I got stopped out of this position. And it worked. It worked for like 25 to 30%. But look, I can tell you my personality, I'm probably never going to be able to sell like the low volume ignite bar. I just kind of know that about myself. But we get stopped out here. That's the end of the trade. So basically in this, there's been 3 trades, and like, I get it. You could have held this and made like an 80% gain if you just held through all this. with my strategy, like I took, what, like a 10 or 12% gain, like a 6 or 7% gain, and then like a 25 to 30% gain. That is a drawback to my strategy, is that you are going to get a little chopped, or just things aren't going to be perfect in these more choppier type of trades, in these choppier environments. um, but I'm showing you this because like that's just how it is. Like
Right.
it's how it is. And I wish I knew what every single stock was going to do, because then I would act accordingly. But sometimes you get these areas here, and it breaks the 50-day and goes down, and then you don't make any money. So it's just like, I show you this so you can kind of see the advantages and the disadvantages of the strategy. Um, this was a really awesome trade, even though it didn't work as great as I would have wanted. If you can pound trades like this throughout the year, you're going to absolutely destroy it. And sometimes this is going to base and go higher, and that's when you're going to get like your 50 to 100% winner. And if you can get a couple of those a year, you're really, really going to destroy it. But in reality, like, a lot of trades are going to be these types of trades, so just like remember that. So that's kind of Roku part one.
And there's actually a question, Oliver,
Yeah.
from Josh. When you're buying and getting stopped out repeatedly, what keeps a stock like Roku, for example, on your watch list?
Well, like, if you go back and look at this time period, like the indexes, were not, you know, it was like a time of year where, even though it was an awesome year and we went up most of the year, like this was the time of year where things got a little bit choppier on the indexes. So you have to take that into account, and you have to take the relative price strength of the stock in relation to the index. So that's kind of what kept me on Roku. And I liked the story at the time of Roku. I then learned more about Roku, and personally, I don't know why Roku exists, but that's just my opinion. And so I kind of, was taking all that into account. I'm taking the overall weekly into account, and that this is really where the stage one area was.
Mm-hmm.
So, like, in stocks that are still in their early innings, if you will, I like to try to stay on them, um, because I think, and this is like how Zoom kind of traded for me too. Through COVID, it was like showing relative strength, but I had a lot of chop trades. But then eventually I ended up having really good trades in it. And, you'll see that's kind of what happens with Roku as well. Um, so I don't know if that answers your question or not, but it's sort of like the indexes just weren't quite ready for the stock to move higher, but it was actually, on a relative basis, like doing pretty well. The market was just kind of holding it back, so that's why I stayed on it. And then it kind of fits the mold of stocks I look for, and then it had a story, it had earnings and sales, it's high price. Like, I like high price stocks. So it kind of fit, it checked the boxes of like a top dog type of idea. So that's kind of why.
And to fully get kicked off your universe list, it would have to break down through the moving averages and that type of thing. Yeah.
Yeah, and it never really like look, it chopped me out of my positions, but this never really breaks. Like, somebody could have reasonably held through this, in my opinion.
Yeah.
Somebody with a more patient personality than me. Now, holding through like this would have been harder, I think, without having hindsight on it. But this, I think you might have been able to hold through. This might have been a little harder, but if you go study, like, William O'Neill would have held through this for sure. Because basically all this does is build a shelf right here, and it supports through here the whole time. And maybe at some point when I get chewed up enough in stocks like Zoom and Roku and the indexes aren't ready, I'll recognize this and I'll be able to hold. I'm just not quite there yet. But that's why it stayed on my list.
Gotcha. Perfect. Yeah, I think we can move on.
Okay, so trade two in this thing is so let's see. Down here we're basically around the same price. It kind of kept chopping around and we get a buy area right here. So buy area is here. You might have been able to say this was your buy area right through here and your stop would have been here. But either or, it's one of these. If it was here, your stop was here, and it never really followed through until here. So when it follows through here on this area, you'd raise your stop to here, and on this area, once it follows through, both would come to the day's low. I think another entry you could consider was this type of flaggish type look where you take out this day's low and your stop would be down here. But in all scenarios, depending on how you analyzed it, at this point, your stop now moves to this day's low. And I think when you kind of get this follow through here, your stop is roughly to about your break even. We go up, we reconfirm, your stop is brought to here. We nearly test that, but we test the 10-day. This is an example of kind of early in the move. If it's above the 10-day, the stock is likely okay. And we go up here and we reconfirm. So now you're raising your stop to here. And really at this point, as the 10-day kind of rises, you're sort of utilizing that 10-day moving average. And as we go up, so this is an example earlier, like I showed the trend line and how it used the 20-day. I will tell you, like, more the way I trade is I'm kind of getting off here and rebuying here. I think both are valid. Realistically, the way I analyze this is I saw 10-day hold, shelf here where we reconfirmed, raised stop to here. And I felt like we were holding the 10-day and we had built like a little trend line here. And when we lost this area, you get out of the stock.
It's a little frozen rope-ish there. Just a little bit.
Exactly. It's a little frozen rope-ish. And then is what we do is we create a descending channel or flag or whatever. And this is another buy area. Stop here, follow through, stop to this area. This is like an ignite bar where you could put your stop here, but sometimes when I get that ignite bar on like day 2 or so, I try to not choke it, even though I really don't want this ignite bar low to go. Like definitely not. And I would say it rarely does. And in reality, when it does, I probably want to be selling it anyway. So really my stop is kind of here. It's just I'm not actually putting it there in actuality. But we move up and right in here we reconfirm and you raise your stops. I do think this is kind of like red flag 1, 2, and really this is a rising resistance line right here that we fail at. I can tell you that I didn't notice it, but for me this is where I exited on a wedge drop right here, where I felt like we had built a little shelf here below this follow through breakout days low, and that's when I exited it. So this is really the first extension to me. And then is what we do is we come in, we basically create a little shelf here, and we have another wedge pop here. Your stop would be this day's low. I think we trade and create another pivot kind of here. And when we take that out, that's when moving your stop up to kind of your purchase area level. Little 2-day area, when we take that out and move higher, you're moving your stop up to here. This is an ignite bar on volume. You're adjusting your stop to this day's low. Inside, almost sort of inside, but it almost kind of fails there. Right here, I'm expecting this to follow through. But it is sort of the third extension. I would have thought this would have gone higher. but it didn't. And when we got this outside reversal here, and we lose this bigger trend line, that's your exit area. If you're aggressive, I think you could sell right here, which because of these 3 days lows and the fact that even though I played these small areas in here, the true trend is defined by these pullbacks to the 20-day and this trend line. And this to me, when we lose this area, is the sell signal. And then if you look, if you wanted to try to wait for follow through confirmation, you exit here on this gap down. And I would say when you get gap downs through areas like this, you want to exit because they can easily really tank. This one ends up holding up for a couple days and then selling. But yeah, there were a couple trades in here, and I had determined the 10-day was holding this, but I think it would have been reasonable for somebody to be more patient and determine the 20-day was. Either or, the overall trend, even if you took this trade and then this trade, you had to recognize the relevance of the 20-day in this trend line. And when we lose this area, it's this is a real breach. This is still playable, right? You're above the 20-day, but this is a real breach. And especially here when we lose the 50-day, the stock, for me at least, pretty much becomes of no interest, until it resets, which is going to take, quite a while. And in this case, it ended up building a punch bowl of death and topping. But yeah, that's kind of how I analyze Roku and kind of how you could implement the strategy with Roku. So basically, breakout, follow through stops here, reconfirmation stops here, reconfirmation stops here, starting to follow the 10-day. First little kind of profit taking, reconfirmation here, gap and trap, kind of second little take note of. This is sort of a frozen rope 10-day trend line, and when we lose this area, I think you could have sold this day or through this low, which it did recover, but you wouldn't have known that at the time. So you would have been out of this thing. Let's say that you sold it here rather than here. You would have been out of it like 327 off like a 230 entry. That's like a 40% gain or so. And then on this one, breakout, stop trades to here in the Ignite bar. Reconfirmation here, this gap, your stops are here. Reconfirmation, your stops are in this range. And, let's say that you sold down here. Let's just say you sold here just to lower the percent gain. You're making about, a 17 to 20-ish% gain or so. Similarly here, breakout, reconfirmation stops here, reconfirmation stops here, moving up, and let's just say you sold. I do think it's pretty reasonable to sell in this area actually, and I also think when it goes red to green to red, you could have got out up here, but let's just say down here. So let's call it like 435 versus like we'll say 410. Not as good, but you string those three together. You probably did better with my strategy than holding in this instance, whereas before you obviously did worse. So there's trade-offs.
Right. I'm not seeing any questions. There is a question about how you use the 5 EMA a little bit. You've probably touched on that a little bit, but it might be worth mentioning again.
Sure. So I only started using the 5 EMA more recently for two reasons. One of my mentors, Jeunesse Capital, he uses the 5 EMA more on like faster moving names. Maybe like a small cap where they really show maybe an IPO, like it worked well on Bros. And then, there's this guy on Twitter, Tony Stark, who I think is probably an exceptional trader, if I had to guess. And he's kind of made me realize that you can really start to see the change of character better by leaving the 5 day on the chart. Um, and as I put it on my chart, I've decided to leave it because I do think, like right here, you can clearly see the change of character, and we kind of ride up it, and then we, come off it and ride up it and come off it. And it's faster moving. Like, I'm not looking to manage my positions with it, but I am looking to, I can see the change of character. Those of you guys who follow Brian Shannon, which I highly recommend, I've talked about his book multiple times. He said that he doesn't initiate swing positions that fight the 5 day. And I think that's valid because if you look at all these buy areas, this buy area is above the 5 day. This buy area right in here is above the 5 day. This buy area right in here is above the 5 day. Below the 5 day, below the 5 day. So it almost kind of just helps you see the flow of the stock, but it's too fast, I think, to manage the trade because most of these bars are ticking below the 5 day. So I don't think you could really use the 5 day. But then when you see that acceleration near the end of a move, I do think that's when the 5 day is most helpful as far as in a bigger capish type name, seeing that acceleration and picking up on that. So yeah, I've more recently added the 5 day to my charts. It's not something I used at all last year, and I'm liking it. So that's what I can say about that.
Great.
Yeah. All righty. So what do we got next? So to me, Tesla has been it's the most important stock. I actually think that I should probably only trade Tesla and I would do a lot better. But I don't. But I think Tesla is the leader of the market from the point of view of a stock with enough market cap to really matter, but then it still sort of moves like a growth stock. And obviously last year and stuff, it was. Whereas Apple, I think Apple, Amazon, those are the leaders of the market to me. But they're not going to move on a percentage basis the same way as a young growth stock. Whereas I think with Tesla, you kind of get the best of both worlds. So this stock, a lot of people probably made their fortunes or whatever you want to call it in Apple. Apple was a huge stock, the last 10 or 15 years. Basically, since I started trading, Apple was the first stock that was the stock. And now as I've more been trading more seriously and actually feel like I sort of know what I'm doing, Tesla's been the stock that I feel like I've sort of developed on a little. So I love this stock. I think it's the leader of the market. And so I want to run through this thing. Basically, we have a big gap up here. You take out day one high. That's the buy area. I think is what we've seen with our earnings gap ups that really, really work is they take out that day one high right away. And I think I read something, I haven't verified this, but I read something or someone told me this that I think it was those O'Neill Disciples guys. I'm not sure, but if a stock that gaps up doesn't go by day 6, it's likely going to base for a longer period of time. I don't know. I just thought of that, but notice that the best ones are usually going pretty quick. So we go. Your stop is here. We pull back. We're holding the 10-day. It's early in the cycle, and to me, I'm probably getting time stop kind of in here. I really can't remember what I did. This was so long ago. But either or, if you did, that's okay. your next entry or your initial entry, whatever it may be, is this buy area, and this is the one that really starts to work. So we take out this area. I think your stop is like below here, below the 20-day, and as we start to work higher, it doesn't really move with authority until this bar. But at this bar, you're adjusting your stop. Roughly, let's call it the 70 area where you're protecting your buy zone. Um, we move up. This is the first pullback. This is a bull flag. I would call this buy area B. This is an outside reversal candle too, if you remember the buy section. And when we push through, you're reconfirming. You're raising your stop to A, to here. And when we follow through here, your stop on buy area B is now here. A is still down here. But then when we reconfirm through here, now your stops on everything are in this range. So we move up, we pull back, we reconfirm again, your stops on everything are to this area. And then I'm kind of taking note, like, hey, we held the 10-day here. We move up, we pull back. Okay, we held the 10-day again, second test. You could consider this a flag, a buy add. I think with this gap, and it would be buy C, you're probably not chasing that gap up. So I'm just going to follow up on buy areas A and B. And any of these other buy areas at this point, you could have tried this and this, but they're all swing cash flow buys. So I'm focusing on buy areas A and B. So we move up, we reconfirm second test to the 10-day. Shooting star here. This is sort of your first, like, oh, maybe some people are taking profits. But there really hasn't been any signs of distribution. And even following the shooting star, there's no downside follow through on it. We support on this gap. And then this is an example of this gap down. It's almost like a nice thing in that you correct and it's a counterattack bar. You raise your stop to this day's low. And then when we reconfirm, and follow through, you're raising it to here. I'm not raising it to this day's low until we follow through on that. It's still like down here because you don't want it to fill this gap because it's so big. But it's reasonable that it could kind of pull back into this range and still be fine. We don't just want to look at this chart. We want to try to create something that's going to work for all our situations. So your stop is kind of still down in this area. But then when we follow through, this is an ignite bar on volume. So not only would you raise your stop to here, you're raising your stop to the ignite bar low. And this is like pretty extreme for the fact that we're, it's 100% into the move. And then this to me is a blow off top. Huge volume. I thought this was a blow off top at the time. I personally thought it was pretty obvious. And I think for a blow off top like this, you take your position off. But let's say you didn't. Let's say you used the 10-day. This would be a tough day, but if you had it here, you supported the 10-day. It's definitely getting loose here. Like, I don't know how you can think it's not loose. And we hold the 10-day again. So what do we have here? 10-day, 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 10-day. 5 tests of the 10-day. We come up, and to me, this is your wedge drop here. So if you had the ability to hold through a blow off top and the impeding 25% pullback, your wedge drop would be right in here. Let's just call it 165. So, really you got to move from say $70 to 165, about 100 and what is that, like 35 or 40%. But I do think this blow off top is pretty obvious. I think that because of the just extreme move from 115 to 190 in 4 sessions, this is an example where your open risk, like, do you really think that this is going to go another 75 points? Like, just straight up? I mean, maybe. Like I always see people who say they're position traders who are like, oh, well, Qualcomm like went crazy. If I had sold into this, I'd miss the move. It's like, well, Qualcomm was like one stock that happened like 21 years ago. So I think generally speaking, you're better off selling into these types of blow offs than like waiting for the next Qualcomm. You know, if you're trying to build a more consistent business, which is what I'm trying to do. Um, but I would say take note of this. This is it. This chart is this. Yeah, I personally think Tesla today reminds me a little bit of this. Um, but I won't get too into that right here. But basically, what do we got? Buy area, flag, reconfirming, reconfirming, raise stops, 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 ignite bar low, blow off top. Sell into that. Okay, if you don't, 10 days clearly been shown as the moving average of note. We continue to hold it and you get your wedge drop here. If you are the type of person that really wants to wait for the wedge drop, no problem. It protects you, it takes you out of the stock. I can just tell you for a fact, well, not for a fact, but with my personality, I would have caved on this day after this. If I didn't sell this, I would. I just know myself, and that's what would have happened to me. So this is an example where the price is so far from your stop level that at worst it makes sense to reduce your position because the volatility to hold this is going to be so high that it's going to be difficult to hold through that pullback. Unless you're just so mechanical that you're going to use the 10-day. And I think there's a lot to be said for that too, if you can trade that way. So that is Tesla, sort of 19 into 20, quite the move. And then we have the COVID, correction, which I've shown you guys all of that before. This is the wedge drop pop coming out of that. If you didn't take it here, this is kind of the buy area here. So let's just analyze it from here. You get it here, your stop's here, we follow through. You're getting your stop, in this range. We move up, we base, we reconfirm, and you're getting your stop here. It then had earnings, which it sold off hard on, and it finds support at the 20-day in this area. Notice how it respects the stop area, and we work higher. It continues to hold the 20-day. So 1, 2, 3. This is the next buy area. I actually think this was pretty unique in that in reality, this is kind of buy point A in a normal market. This is kind of your cup and handle. So really, I think that these buy areas all the way up until here are really, I think this is buy point A, this is kind of A1, and this is buy point B. So you could, I think you should buy and add more here for sure, here and here. Your stop would be below here, so you follow through, you kind of get your stop to this area. If you take this buy area, you're buying here, your stop is here. But as we follow through, buy areas pre-A and A are here. Buy area B is now to here. As we follow through higher, all stops are kind of in this range-ish right here. And really your buy areas down here, maybe you're even giving more to the 20-day. I know my personality, the most I'm giving is to right here. We move up, we pull back. I would probably say, we're kind of holding the 10-day here a little bit when we come through, but we don't reconfirm yet. We hold the 20-day and show the 20-day again. This is a nice solid base. This is buy area B. I think this is definitely a buy area you want to be taking. If you're taking this buy area, your stop is down here. As we follow through, your stop is here. As we kind of follow through again, all buy areas, pre-A, A, A1, and B are right here. And part of the reason I think people were able to do so well in Tesla last year is because of the way you got like 4 buy areas off the lows in Tesla. And like, look how uniform it was. So, you're able to get a lot of stock on, um, because of the way that it traded, which is why big corrections are awesome because you get to see the best stocks, and they give you a lot of opportunities to get on, and the buy areas follow through because it's like early innings, whereas late stage I think we're seeing a lot of buy areas get scummed. So basically, we're right here. We're moving up. Kind of, I think it was net we looked at earlier, where I would kind of expect like a little bit of consolidation here, but when we move higher, through here, I'm probably moving my stop to here, and then you move higher again. And once we for this, because we've kind of had multiple gaps, I view that as a sign of strength, but also blow off you a little bit. But I might want to give this Ignite bar a little room. But once we put in this area here, this to me is very late stage swing entry if you're going to take it, because we're really getting extended. Notice the acceleration and that we've held the 20-day the whole move, and now we're pulling back, finding support on the 5-day. So when you're breaking out here, your stop's going to this day's low. And I do think it's reasonable to sell this extension, because of the acceleration up the 5-day. But if you don't, the wedge drop here takes you out. And notice a couple things here. We kind of push up here and they fade it, meaning there's no follow through, a potential lower high versus this outside reversal. So outside reversal is the reversal extension. And then similar to some other examples we've shown, they gap it up and sell it into the wedge drop. So if you didn't get this and you got out here, call it like 310 or something. Even from the latest buy area, you had like a 50-60% gain. And, from the first buy area, you had like a 200% gain, which is, we need more of those. But then through here, even if you didn't take this wedge drop, which I feel like with the acceleration, I think most people would have, but you definitely get it here, through the 20-day at worst, and that's kind of the trade off the lows in Tesla. And so, any questions there, Richard?
Yeah, there's a question about back at the end of April. Why wasn't that a wedge drop? Those 2 days where we had the gap up and then sell off and then the fall through the next day.
Yeah. So I think you could have treated it that way because of earnings. I think you could have definitely treated it that way. I think this is a unique time because the COVID correction was so deep, and
Right.
I think Tesla was clearly showing itself as like the leader, and we
Yeah.
and we held the 20-day. But I think you could almost view this situation like the Livongo and Peloton
That's what I was thinking.
situations.
Yeah.
Yeah, where then when you get this bullish engulfing, maybe you treat this as like the shakeout.
Yeah.
Um, I think that type of thought process is pretty reasonable, given the situation. But I also think with earnings and everything, I think you definitely could have treated this as the wedge drop through the 10-day here, for sure.
I think all those bases are like so textbook. You've got the drive-in volume.
Yeah,
You get the price getting super tight. It's a nice chart to look at for sure.
yeah. I mean, this is like ideal. Like this is the example everybody wants to show, which is why I tried showing some of the other examples where
Yeah.
it's not quite as clean. This is like beautiful. This is amazing action, and um, very technically sound as well with the way it held. You know, my strategy loves situations like this.
Yeah. Yeah. And you had all the top dog qualities coming together. The earnings, sales, the industry group is strong. All that coming together. It's a huge
Yeah.
liquid leader too. So
Yeah, everything. Big, liquid, um, you know, really, I think if I would be more cognizant on trading the top 3 to 4 names, like only, like the Teslas, the Nvidias, I'm personally thinking that's like safer than being in like 10 names.
Yeah.
Just because, you know, those are the names that are really going to work the best with my approach. The big liquid ones that move uniformly for sure. Um,
Perfect.
so Tesla sets up again. So this is that wedge drop that I just showed. So this is that extension, the wedge drop. And then what happens is we gap up and we set this pivot. So this is like the wedge pop, which I think you maybe could have had it this day. I really can't remember what I did. I think I might have had it this day. But then it follows through it. You know, and this is like tough to buy something like this because it's not like, I mean, it's tough and it's not tough. Like we clearly clear this area, and this is a buy area. I can't remember if there was a catalyst here. I think there was. Um,
I don't
I
remember
can't.
either.
I can't. I think maybe
Yeah.
it was this. Was this the split? No, that must have
That
been
was later. Yeah.
Yeah.
I'm
Um,
not sure.
I can't remember, but either way, it comes up, triggers this buy area. You know, your stop would be like down here, and then kind of when we get followed through, really kind of this ignite bar day, your stop's definitely going here, and really with the ignite bar, you're putting it here. We move up, we base, we reconfirm. You're raising your stop to here. We go up. You kind of get your first kind of profit taking day. Oh, like kind of take note of that. Um, they support it. We reconfirm. You're raising your stop to this area. We move up. You're getting another ignite bar on volume. So you're raising your stop to here. We go up. I'm personally thinking that we're just gonna hold here. But then if you, I should have drawn this stuff in, but there's a trend line here. Your ignite bar low, and you'd be stopped in this area, which I think there's no reason. There's a reason why this bar had so much selling, because there's a lot of people probably trading just like me. You got your trend line, and you lose the ignite bar low, which is a bar of significance, and sure enough, you see a lot of selling there. This, I think, I remember this because I bought this pullback here, and it came out that Etsy was getting added to the S&P, I believe it was, and Tesla gapped down, and this really sucked for me because I sold, and you can't win them all. But to continue with Tesla, this was the S&P ad.
Yeah.
So this also I want to highlight on the weekly was the second extension. So when you get that second extension, at least for me, I expect a basing period. So this was a wedge pop here, which I think you could have taken, but I think you would have had to have taken it with the understanding that you're fighting the second extension. And sure enough, it just didn't really work because we needed to base. But right here, we gap up, we set this pivot, which reminds me of that Peloton example I showed, like maybe the third buyer in Peloton or something. But when we push through, your stop is here. And when we kind of follow through, probably when you take out this area, when we reconfirm, raising my stop up to this range, push a little bit higher, raising it to this day's low. We move up, we pull back, we find support at the 10-day, so just kind of have to note that. This right here to me would be a buy add area, a little extended for a B buy add just because it's kind of moved. Really for me, you want to have your B buy add like right in here, or like maybe around in here. So this is a little extended, and sure enough, you would have been stopped out of that second buy add when it fails the day's low here. But you're still in this one, and they gap it down, bullish counter attack. To me, is they're kind of putting the low in this new area, so you're raising your stops to here. And again, you get another buy area here that fails, and that it shakes out. Again, though, notice like these are later buy areas, but right here you're probably selling this day, because we break out, we really get moving, and then so your stop should definitely be to the day's low, and then when the pivot doesn't really hold, you should be getting stopped out on this. Um, and then there is another area right here that ends up working. So it just goes to show you sometimes it takes a couple tries, and that's just kind of how it goes. But your A buy area is fine the whole way. Like that's just the importance of getting the initial buy, because the later you get the buy area, the more prone you are to be shaken out with kind of how I manage my stops. Um, so basically, we hold the 10 day, 10 day, 10 day, 10 day really in this area. Um, and then we reconfirm here. You're raising your stops. If you took this buy area here, your stop is down here. And then when we reconfirm, or sorry, when we kind of follow through, you're moving it to this day. And then we pull back. When you take out this high here, you're moving it to here. But then when we push higher, all positions, all buy areas, your stop is right in this area. We go up, we base, we push through, we reconfirm, your stop is this area. We then get an ignite bar, your stop is this area. um, this is actually another ignite bar. And to me, if you looked at the weekly, I feel like this was fairly obvious. Richard, I think this was like when I was on your podcast or something, and talked about how I thought that this was likely going to not be the top, but I thought that we were just so extended that we were likely to reconsolidate. And sure enough, that's what happens. You get a wedge drop here, to me, is really kind of the wedge drop, but then definitely the confirmed wedge drop here, and you go into another basic period. So basically, buy area, reconfirmation, raise stops, reconfirmation, raise stops, counterattack. I think you're raising stops here, but then reconfirmation, you're raising them here. Reconfirmation, raising stops to here. Reconfirmation, raising stops to here. We've defined, in my opinion, it's like 10 day, 10 day, but you're kind of taking it down, and it's really kind of the 20 day. And really, I think Tesla, if you trade it enough, it really shows the 20 day. Its life cycle is a pretty important moving average. And then we start to accelerate, hold the 5 days, we accelerate, into the top. And sure enough, we have a failed breakout here. So if you think about this, even let's say that you didn't sell into this because, that's a pretty good sell. You get some profit taking here. You then have an empty wick candle here, kind of unable to push higher here, bearish engulfing here, just lack of momentum, and then kind of a failed breakout here, an inside bar that trades down. After all this, to me, you've got to be sensing just kind of some weakness. And on this gap down, it holds the 20 day, but like right here, if you were still in it, you would have to be gone, because we'd held the 20 day the whole time, and we take out this day's low after it's supported there. You have to view that as your stop area. So I think at worst is you took this from, I'm going to say 450, even though it's a little higher, to 800. So it's like a 50-60% gain or so, give or take. And that's, again, Tesla just trades so technically sound. It's it's really just the best stock to trade.
And there was a question here. When you ultimately end up selling your position, or a portion of your position on that day, are you selling it all at once, or are you selling it throughout the day as the stock continues to weaken?
I mean, when you say when the stock continues to weaken, which day?
I guess it depends. Like on a wedge drop, do you sell?
Oh yeah, I
Yeah.
sell it. I get out. Yeah, I just sell it.
Okay.
I mean, I'm not running, $1 billion, so I
Yeah.
can just get out.
Cool.
Yeah.
Yeah. I think that's the only question I had.
Okay, cool. So the next relevant, I want to show you again. I want to show you some trades that just don't work out that great. So Tesla corrects, and it has a reversal extension here. It comes up, it tests the 20-day, and it sets up, and it has a wedge drop or pop here. So this is a buy area. It then flags. This is the crossback. I thought, we were back to the glory days in Tesla. I had bought this and I had sized this because, like, look at how great the risk reward is here. It's an inside bar right into the 10 and 20 day. And then we break out. So basically, wedge pop stops here, come back. If you bought this breakout, your stops down here, and then when we kind of follow through, your stops here. This is an ignite bar. Your stop is here, and I gotta say, I was pretty fired up. And then we kind of get this reversal bar, which made it not quite as exciting. But then we support here, and I'm thinking, okay, this thing's gonna push back up, and then I got stopped out on the ignite bar low, and it's just an example of, from your first entry, what it works for 50 points, like 7 or 8. Your second entry, let's just say it was a scratch, and it ends up trading back higher, and but at worst to worst, your max wedge drop was here, and it just doesn't work. The trade just doesn't work, which that's how it goes. And in reality, is what happens here is you get a wedge drop, a cross back, and this ends up being, a short sell. But so that's just an example of a trade that just looked promising. This had a nice base at this point too. So if it had worked, like, you could almost thought it was like the bottom off of COVID, where this could have really, really been a big winner. And it wasn't. So that's just kind of how it goes. But is what it needed to do is kind of reset and build a base into the 200-day, and it came up here, and I was a little suspicious of this breakout here personally, because I had been looking at the volume on Tesla on the weekly, and it looked like there were no real big players involved in it. But that's neither here nor there. We break out. So if you break out here, your stop would be down here. And then as we follow through, you get it to here. To be transparent, I didn't take this trade because of what I just told you guys. But it worked. And I did get involved in it here on the gap down on earnings. It had a bull flag, a gap down, it had an outside reversal, and it traded higher. So your stop on this area and this area, once we reconfirm, would be this day's low. Kind of once we follow through here, I think on this buy area, you want to try to get your stop around here. I think on buy area A, you would still leave it down here, just because you got a good price, you don't want to choke it off. But then when we gap up and push, ignite bar, you want to raise your stops. So you get reconfirmation, ignite bar, raise stops. This is kind of that, fourth day shooting star that just doesn't matter as much to me. Then you get a wick play, which because of the wick play, I think you play this buy area. I did. So on the wick play buy area, you're buying through here. If you want to give it a lot of room, your stops are here, but I think you got to keep your stop here. And then for your buy areas A and B down here, now you can raise your stop here. When we reconfirm on your initial buy areas, you can keep it here now. And then when we move up again, definitely to here, but on this ignite bar, I think you're keeping it at the ignite bar low. That's what I did. We trade inside, we reconfirm here, you raise your stops to here. And then this is a tough one because we reconfirm, but we don't follow through. And then you get the gap down, which I can tell you, my stop was in this area now because we reconfirmed my stop was here. and the gap down sucked because it basically gapped here, and the 10-day was right there. So I decided to give it to the 10-day, and then I got stopped out through this day's low. You know, I guess you could say in hindsight, when this traded down and reversed, you could have got out here. But, I think that's kind of hindsight. Notice how we did gap up, though, and they sold it from red to green. I think hopefully you can see that consistent theme. When they're ready to start selling a stock, they like to gap it up, the institutions, so they can unload their shares at a better price. And this traded Tesla. I had much, much higher hopes for this, just to be straight up. I thought we were going to hold here and maybe recover and continue. But it just didn't work out that way. And like I said, I haven't shown here, but I personally think Tesla currently, and I think it was sort of confirmed on Friday, is showing very similar characteristics to that Feb 2020 top.
Perfect. Yeah, I don't see any questions. So I think we can keep on with the examples. We only have 2 left, I think. And then
So we'll blow through these. I know we've been on here for a long time, but so SI, we've been over this before. They had a secondary, it broke out, so I'm not going to go through this, but breakout, your stop would be this day, probably down here initially, but then when it follows through, this day's low, come up, pull back, reconfirm, stop here. This would be buy area B. Go up, pull back, reconfirm, stops to here, kind of follow through, put it to here. To me, if we had one more day here and gone, I would have considered it reconfirming. But kind of once we push here, now I think you can raise your stop. We move up, first sign of profit taking, second sign of profit taking, but we build a flag, we reconfirm, stops up to this area. At the time, I had thought this was a second extension, but in looking back on it, I think I'm price fitting. There really wasn't a second extension. I think this is probably the first extension. We pull back, we hold the 10-day. There's a trend line drawn here, and then when we lose this trend line, there's a big shakeout, and this is what you're going to get with these less liquid type names versus like a Tesla. You're going to get crazy moves like this. But couple just signs here, profit taking, to me, an empty wick, profit taking. This kind of sell down here is not the best sign. And then you get that gap out down, you got to be ready to sell on this thing. I can't remember. I think I was caught in this for part of my shares. But I think I got out of it okay. I know some people who got filled, unfortunately they got filled literally down here. Like this thing flashed down. And that's what you're going to get when you trade these less liquid names versus like a liquid stock. So you just have to take that into account when you're trading the stock.
Yeah, I was one of them. Unfortunately.
Sorry, man.
No, all good. I got a pretty good entry on that, so it didn't end out too bad. So I don't see any questions about this one, but I think we can.
All right, we'll keep moving. I know people are probably getting tired. I'm sorry.
No, this is great though. This is awesome.
Okay, cool. So SSYS. So SSYS and Triple D were great trades for me earlier in the year, and they occurred on this day for Triple D. I think I don't pay that much attention to the news, but I think they like raised guidance or something. But the volume was just like massive, and I had traded these things in like 2013, and I won't lie, I have a personal bias to trade SSYS over Triple D. I took them both, but SSYS was my focus. And basically, it bull snorted. It traded tighten inside. This is the buy area. Your stop would be right here. As it kind of follows through, your stop is here. As it reconfirms, your stop goes to this area. Same deal as it reconfirms again. Your stop goes to this area. Ignite bar, stop to this area. Reconfirms, stop to this area. To me, this is a concerning bar, but there's no volume on it. See the dry up, so it really is not meaningful. This is your first kind of profit-ish taking type of bar. Right here, we reconfirm stops up to this area, trade inside, trade down, hold the 10-day, hold the 10-day again. We sort of build a little shelf, and I think this is your stop area. I think one of the things to note here is the personality of this stock is it's a real high flyer, and it's also off the lows. So you know there's a lot of overhead resistance, and you've got to respect that. And then I talked about earlier noticing a change in character and kind of weakness in your stock. It had traded up. Oh, this is like a frozen rope, sort of like that AMBA example. And we started to trade sideways through this trend line that it had really held strongly the whole way. So you got to be alert for that, and just get out of the way. This is also an empty wick up here. I think I took some off in here and then got stopped out of the rest. I think it was on like this day, even though I think I got stopped out of the rest here, and then I was like, oh man, this is gonna rip higher. But then it ended up kind of falling apart. And you'll also notice, I didn't have the 5-day at the time, but notice how the 5-day kind of shows you that change in character, and that it starts to slope down before this shelf break. But this shelf right here, I think really this day, if you're being honest, this is where you probably would have sold through this shelf, and then you would have regretted it, and then the next morning you would have been like, oh, thank God. And that's SSYS.
Yep, I'm not seeing any specific questions on this one. So I think that's all the examples. We've got your homework. Oliver, you go to the next slide. It's basically to mark out the chart of TTD with basically what Oliver's been showing, going through the buy, sell, position management spots, where you would move up your stop, all of that. So I definitely want to see everybody watching to post that on Twitter, tag us, and definitely get that submitted, and we'll give you guys some feedback. But with that, I think we'll cover the 3-bar break pretty quickly. Oliver, if you want to go over to Thinkorswim.
Yeah, let's see. So, what do I got here? So yeah, I'll show you some examples. So Asan, I had been trading Asan, in this area, and this is a 3-bar break right here, where it gaps up and it takes out all these bars. And that's really a major day to take note of, because it's on volume and it's just very uncharacteristic of any other price action we've seen. And sure enough, tries to break out here, fails, tries to break out here, fails. There's so much distribution taking place here, in my opinion. You're getting just not great action here, false breakout here, followed through down, false breakout here, distribution type action here, just a reversal candle here. And this is wedging action where you're taking out the highs and unable to push higher. And then sure enough, one day it just explodes and gets pounded. But it all really kind of started with this heavy downside bar.
And to define it, correct me if I'm wrong, it's basically a short consolidation structure, and then 1 bar takes out the lows all in one day. Yeah.
Exactly. So if you think about it, this bar took out like 4 to 5 days of price action. Just right. So, that's significant. And it was kind of what I said, where Trader Florida teaches, like you get 3 or 4 signals. Like if this is the shot across the bow, like this is almost kind of 2, this is sort of 3, this is 4. And by the time we lose this area, the writing was kind of on the wall, in my opinion. So that's an example of a 3-bar break. I would recommend, going back and reading chapters like 10 and 11, how to make money in stocks. Like like Net is another stock. I know a lot of people traded. I did, and it fades on earnings and comes back up. You know, this is like railroad tracks. Like that's another thing you can utilize. And sure enough, we test the top of this fail, and then this thing falls apart. Um, so you know, and I think Dawkins was another one. A lot of people were probably in. I mean, this is definitely a 3 bar break. There wasn't, in my eyes, there weren't like major reasons to think this would happen other than it was very, like how extended you are from the 10 week. This is an example where you're so extended from the 10 week, like if the stock did pull back, like it could pull back to like 100 and not be totally broken. So that's just an example where you're fairly exposed. But if you were to kind of look at this one, just because I know people are trading this, you know, you had a breakout or ignite bar here on earnings, stop here, go up, pull back, reconfirm, stop here, go up, pull back, reconfirm, stop here, stop here. And there's no mistake why this was such a huge sell down, because a lot of people who trade like me were, you know, 10 day / this day's low. You know, you gotta be careful. Yeah. And so yeah, I mean, Richard, I guess while we're here, you know, maybe I'll just look at the Nasdaq real quick. So
Sure.
I'm pretty not high on the market. I think we got a reversal here. That to me wasn't a reversal extension until after the fact. But I think we then put in a lower high here. We had a wedge drop here. I think is what we saw this, what, Thursday, Friday was a crossback. And I am not very positive on the market. I think if this weekly breakout fails down through here, you know, I think because of how far we've come, I think that there's a lot of room, maybe down to the 200 day. You know, I don't know, but I think that if you pay attention to the cycle, we've had our extension, we've had our wedge drop. I personally think this was the crossback, and things can happen much more quickly to the downside, but
Right.
I think we're definitely going to get at least a basin break and then a washout. Um, and there's no way of saying we don't get 2 basin breaks. Like, could we hold this 50 day here on a back test of this breakout? Sure. But I take a lot of my signals from Tesla, and I look at Tesla and I think that we had a subtle unfilled gap here showing weakness. I think this is major distribution. I think this is distribution. I think this is a second lower high. And I think that this was, you know, a wedge drop right here. And I think that this is going to play out. I think we're seeing the 5 day cut down through the 10 and 20. I think once you see the 10 cut through the 20, if we lose this area next week, you know, I think it's the 50 day to me is unlikely to hold if that happens. So I think the next logical spot would be to fill this gap. And personally, I think if you go look at Tesla in 2020, we went all the way back to the 200 day. So that's, look, I don't like to make calls because I'll kind of change my mind if I have to, but I personally think we're likely to fill this gap, and it wouldn't surprise me at all if we traded back to the 200 day moving average. And I say that just because when I go look at Tesla here, where I kind of think it looks similar, you know, that's what we did. So, you know, we'll see what happens. I have no idea. I love the stock, so I hope it repairs. But that's kind of what I'm thinking, and I don't see a lot of fear in the market. So you know, we'll see what happens, but I'm not very optimistic right now.
Perfect. Yeah. but corrections create so many new opportunities. So we look forward
Yeah.
to the next uptrend.
Oh yeah, absolutely. Honestly, we need it. It's going to make the market a lot easier to trade. So I'm looking forward to it.
Perfect. Um, yeah, that's pretty much it for today for webinar 4. Thank you guys all for sticking with us for I don't know 4 hours and change. This has been a marathon, but so many valuable pieces of knowledge that Oliver shared, and I especially really enjoy going through the charts and seeing the position management pretty much in real time. So yeah, there's a lot of thank yous in the chat, Oliver. So it's great to have you guys with us. Enjoy the rest of your weekend, and we'll see you guys in webinar 5 to finish this thing off strong. And take care, everybody.
Thanks, guys.